GetCrack. Wake up, motherfucker.
Yo, what's up? It is March 10th, 2025. Happy Monday, or is it a Black Monday? Let's see. Okay, let's go. Let's get this thing going. So I saw some nice things just in the last hour. I'm coming up on here to update you guys. As you can see, QQQ bounced off of 468 right now. Okay, we're way below all these little minor support lines, so we're trying to make a bottom right now, as you can see. MSTR, okay, we're right back at the level we were last week and the week before on Friday. So 2 times hitting around this 237 and 231 area. So we hit it again. So if you're in here, get the MSTX if you want to do a little gambling this week. Okay, MSTX, buy that at 1872 right now. Okay, and we also have a nice discount on SOXX, so use XOXL. Okay, $17.83 right now. It went down to like 17.20. Okay, SOXL 3x leverage of the semiconductors. Let's see what else we got. NVDL. So this is 2x of Nvidia. So Nvidia hit a nice new low. Okay, I'm going for it. 36.83. All right, so we got 36.11. Let's see what happens, and then let's see what else. Tesla. Okay, remember I was saying like, oh man, well, Tesla's hitting nice new lows right now. When it got right through here, I think around this level, 265, 290. So now we're at 221. All right, I'm gonna try it again. I'm gonna try it again at this level. Okay, so use TSLR. Let's see what we can get. $11.50 right now. Okay, down 30% for this leverage 2x on Tesla. Go for it. So all these big caps we're talking about. I mean, another one you could look at too is WebL. WebL is 3x internet stocks. So, I mean, it's the same kind of risk reward as SOXL right now, I think. Maybe. So, yeah, I mean, I don't think there's going to be much difference between WebL and SOXL. So WEBL versus SOXL. But yeah, you could try to trade this leverage really quick now, this week only. Okay, get this thing pumping. Let's hope for Wednesday everything goes well. And then, so also tomorrow we'll have Jolt's data at 7 a.m. my time, so 10 a.m. Eastern. And then we'll have inflation CPI on Wednesday, I think 8:30, right? So, and you have to remember the time zones. Also, we had to like shift the hours because of the daylight savings and all that too. So keep that in mind. So if you're using TradingView, you know, I don't use local time when I do TradingView. I just use like you can see here, I just use UTC. So basically Greenwich Mean Time, so London time. I just keep it the same. No, it doesn't change with daylight savings. So when you go before daylight savings, the U.S. market opens at 14:30. When it's after daylight savings, the market then opens at 13:30. Okay, so keep that in mind if that's how you set your trading view. So I don't know how the Thinkorswims, like if what's the defaults are, but I like to keep it like this. I like to use this just the UTC time. And take into account that, yeah, you're going to have to shift your data in your head. Like, okay, this thing opens at 13:30 now instead of 14:30. That's about it. And it closes at 20 instead of like 21, or I don't know, whatever. You got to figure that out. Yeah, I keep forgetting which time is which at the end of it. Okay, so that's it, I think, quickly. The other thing to notice today was natural gas. So last night, overnight, natural gas pumped. I think it's just because of the tariff stuff. It wasn't because of the weather. I don't think it was weather related. So this thing had a really big explosive open on the futures, and then it just faded everything back. Now, we're on top of this resistance, though, for the spot natural gas. So this is $4.50 per million BTUs, British thermal units. Now, if you look at the futures, let's look at this right now. I'm looking at the June one, okay, because that's where like the boil and cold, they react to the June futures contract. If you look at this, you see this instead. You see there's no trading here. That's why the spreads are like this. You see these huge gaps in because nobody was trading like 2025 futures in 2020 that much. There weren't many traders. But once you get closer to 2025, you get more and more trading, and then you have a smoother bars being constructed and a lot of volume coming in. Now you see this, right? Guess what? If you just look at these futures back in 2022, these futures were pricing 2025 gas prices at $4.60 something cents per million BTU, and we just broke out of it right here. So this is significant. This is going to be significant. So now, would I say short natural gas for the week? Yeah, sure, maybe. So if you wanted to do that, you should have got cold today. So let's see how low cold has gotten on this day. Yeah, not too much, not too much. So it got down to 16. If you could trade this overnight, then you probably got cheaper price, okay? But it's still a decent price. So I think right now we're at a top, but you never know. This might just go sideways this week. So I'm not guaranteeing this will explode back up. But once it does, let's say you want to go long on natural gas, wait a while, all right? Wait a while. Because I think we can go sideways here between like 90s to 100, but maybe one bad day you get down to 83 in a couple weeks. I would be starting to think to go long, all right, because it's so bullish that I don't think we have to wait too long for the final thing, because usually what happens is like this: you go up in the winter, you pull back, but you don't go anywhere. Like, you basically fall through into March. So this thing should have been sliding all the way into March. That didn't happen, right? You got the tariffs, you got some nice weather reports, that winter weather, cold weather in the Northeast and in the Midwest was sticking around through March. So it's kept this thing high throughout this whole period. So it's draining a lot of supply from the tanks, all right? So it has to be stored. Now that means you want to get long, seriously long, before the summer. All right? Okay. So hopefully you guys got that message. I think that'll be really good for another maybe 100, 200% move. All right? Okay. Well, if we're lucky, we get a 200% move. I can't guarantee that. All right, 5 minutes until the market closes. Soxal covered that. All right. Tesla covered that. Let's see what else. I mentioned ASTS over the weekend on Saturday. So, man, it's a tough call here. We're really running out of time. Like, I can't. Like, this thing could just pull all the way back to 24 or 25, and I bought this at 26 somewhere, 26-ish, somewhere here, I guess, halfway in this candle. Yeah, I mean, am I going to be really bullish that will break out? It's hard to say, but yeah, that's the only like small cap stock I would be paying attention to, because there's just too much noise right now. The volatility is so high. Yeah, you're taking a lot of risk with small cap stocks. It's just easier to short them at this point. Like, I told people, like, as a suggestion, if you wanted to short a stock, like back here, Thursday to Friday on the 28th of February, I said, hey, you know what? Just short AAOI. So far, it's just been dropping very easily to 14 now. The next one will be 11, 10 is to 11, and then 9, and then maybe even going down to 7. All right. So I don't know. Antoine was curious about options. And I said, hey, you know what? You should practice some of your shorting techniques with options and use this one because I think because it's a small cap that's not followed very much, it might be cheaper, because like let's say you wanted to short a big name stock, right? Like Tesla, it's probably too expensive, I would think. So let's say you start doing it here, it's probably costly. And so the risk is higher that you make a mistake, So because I never traded options, so I couldn't tell. Like this looks like it's easy to do, right? You would say like, okay, you bounce here, you short here, right? And then you just let it go. But depending on the cost and where your strike price is, this might be you might have not gotten a lot of gain here as you would with using AOI. So for the same time period, you could have been shorting here and getting far more gain. Like that's possible, you know? And yeah, that's why options is a whole it's a whole another can of worms. And I have some videos set up to discuss options, like really advanced topics that maybe might be useful for some of you. But even if it doesn't, it kind of gives you more, I think, flavor of what you can do with options, which you cannot do with one-dimensional trading just using price, because price just moves up and down. That's it. That's the only dimension you're given. But with options, you can do volatility, and other things. That's the key, right? All right. So yeah, if you wanted to short this one, use this one to practice with, because I think the other ones are just too expensive, too popular, right? They're going to be too expensive. Everyone's going to crowd into Tesla or Nvidia to short. That's just like, maybe you're not going to get as much gain, or maybe you'll make a mistake and you end up getting the wrong contracts to set up your play to go for it to go down. Let's see what else we got. Tomorrow we'll have Zim earnings. Yeah, Zim in the morning. Yeah, I'm gonna be curious how this goes. I don't know why they got takeover rumors now. Curious, very curious. I want to see if it gets to 23, go back to 30. Let's see what happens there. That's about it. Okay. Nothing else. All the small caps are still going back to their old levels. Yeah, what's up, CKJ3? Okay. Oh, yeah. You see, like a tie. I was talking about this stock. Remember when this thing was going up here, and then since it couldn't even get through this resistance, now it's all the way back down to where it was in its range. So yeah, so that's why ranges are very important to look at. If you look at this long-term chart, it's a no-brainer, right? It's just like, unless you have a complete follow-through, you're back in there. Goodbye. And then Mind Medicine, same thing. This range here, and then what else? What other potential? Oh, RX. Remember this one? I said there was a chance. There was a chance it could break out, but then you could tell like that whole week was like, okay, gave it all back, and it's like, oh, we're right back at the bottom again. This is a range. This is also a range. So pay attention to these ranges. Let's see. All right. Yeah, this is pretty much it. Pretty clear, right? Buy at the bottom, sell at the top. Buy at the bottom, sell at the top. Yeah, short at the top, cover at the bottom. Short at the top, cover at the bottom. Very basic. Until it doesn't work, right? Until it doesn't work. And when will you know when it doesn't work? I think there's telltale clues. Let me see. What was that? BYD, DDY. Yeah, this is a good example of one. Right, you have this kind of range here, all right, since 2020, 2021, 2022, 2023, 2024, and then you break out. There you go. And the thing is, you notice here, this had a huge volume here that week or that month. This is a month, right? This is a monthly candles. And then you go right back. And the next one, large volume. And then you start climbing back up. This is larger than anything here. Anytime it hit that low, it was never as much volume as here. So you know that time there was something going up. So I think when I talked about this stock over the summer, and I said, hey, this is a Tesla competitor. This thing is just going to be like, it's going to win. This thing is going to win. It's going to break out. And then guess what happened? It broke out. Now, does that mean we continue on with Chinese stocks? Well, let's see. Let's see. Later this year. Let's see later this year. I don't think I want to do any buy back any of the Chinese stocks I sold so far. I'm not going back into these things. So hold on. Hold your horses. If you missed out, wait a while. Same thing with Deere. Very good. It has a nice range too, right? You see that? It broke out. And I've been saying like this is a great long-term stock. So a lot of people got like somebody on here was talking about like, oh yeah, Deere. I don't know about Deere because of the tariffs and all that. Because I think during the the campaigns for the elections, he was claiming he was going to add 200% tariffs on companies that built in Mexico or something, because Deere was planning to move factories to Mexico, stuff like that. But as you can see, it didn't matter. It's outperforming a lot of other stocks that never had like specific tariffs aimed at them. Trump specifically was saying, Deere, I'm going to put, but that could just be election talk, right? A lot of stuff is only talked about in the elections just to get votes. So all these other ones like Walmart, well, yeah, it's going to get problems right here, because that was what caused this whole drama right now, right? Because Walmart's, when they released their earnings and they did the guidance, they were specifically worried about tariffs. So I think that magnified people's sensitivity to the word tariffs. All the algorithms are set to the word tariffs. Anytime anybody breathes tariffs, it'll just cause problems. All right. So this is where we are right now. Okay. QQQ. We're here. We're right here. Okay. Nasty month. It looks like it's going to be a nasty month, but the month's not over yet. The month's not over. So we still have time. And I'm going to see if this level is a good level to try this week. Okay, so I think I played a little bit of Samantha LeDuc's video, so I'm going to continue playing her video. And what you'll see is that she says, or Hans, her employee or compatriot, says about let's see, SPY around 5,800. All right. So as you can see, I drew this blue line way back when. And you could tell like it was at a minor high back in October. So there was a gamma flip level. Now, what is a gamma flip? All right. So let me put SPY on this chart. Maybe it's more clear. So I drew, this is my prediction. It's like it's going to bounce somewhere up here. It looks like we got lower, okay, this week. So let's see if we can bounce at least somewhat to 5,800, okay? So that's corresponds with 580 in the SPY. So 5,800 in the S&P 500 is SPY 580. So this level is important because it's the gamma flip level. So I'll define that to you later if you guys don't remember when I went over gamma. Now, the other level was this in the 595 level. And why was that significant again? I forgot, but there was another options reason. I think, okay, this was the gamma flip level. My bad. So 595. So that means 5,950 is a gamma flip. 5,800 is when the downside gets very extreme. Okay, so you can see like when I'm just using charts, all right, when I'm just using the charts, I'm just looking at support, resistance, all that good stuff. And you can tell like I drew this rectangle because I saw like there was a lot of fights going on. So this was after Jerome Powell did his thing in December 18th. Okay, so now you would see like, hey, look at this. Every time it jumps to this point, it goes above, comes back, goes above, comes back, goes above. So this area here is a big place where they just have a fight. So when you came from below, it would try to get in, but get pushed out. Then it gets through, then it goes all the way to the top. Then when it comes from above, it bounces off. It bounces off. This time around, though, you can see the way we came into this rectangle was very severe. So from that Friday, so after Nvidia, after Walmart, all that stuff, that week we had Max Payne too. Then the following week there was no showing of improvement because every day then it was just red candle, red candle, red candle. And then finally you hit Thursday. Oh Lord, terrible, terrible, right? You just completely collapsed, completely. No good. So oh yeah, this was Nvidia. My bad. This was the Nvidia. I think this was the man. This had to be Walmart then. This was Walmart, and then several a week later, then it's like in Nvidia. Okay, that makes more sense. That's probably what it was. And then now we have this. Okay, this move here on a Friday. So this was just a kind of response. You know, it makes sense. You just kind of have, if you have a high volatility day, you're just going to continue it up. But that wasn't a good sign at all because the next day, on a Monday after the weekend, you see it try to get above slight. Well, I mean, let me zoom in. It kind of tried to touch that top of that rectangle, but then it just falls right back the whole day. And when you see something like this, when this red bar just completely envelops this, and then you see this red bar before it, it's like, whoa, volatility is so high. And now, if I give you the reason why this is happening, it's because this level here, this 595, which is halfway inside this rectangle zone, this level was the gamma flip. So the longer it stayed below that 595, volatility just increases. So selling makes more selling. Buying makes more buying. That's what the gamma flip level is doing. Okay, I can read you a proper definition and then hopefully you'll know. So if you're just looking at a chart, you wouldn't know that, right? You don't see any options here. You don't understand what it is. All you know is like, wait a minute, I just drew this rectangle, but I just assumed there was something going on because it kept acting the way it did around it. So when you do technical analysis, the idea is if you do it well enough, it's good enough for you to figure out everything else. See, I didn't need to know like the inside, what was going on in the engine. I didn't need to lift the hood and look inside. I just need to drive my car and feel how the car is rumbling, right? A lot of times people back in the old days, you could just, a lot of old mechanics, they could figure out what was wrong with the car just by the feel and the shake of a car because it wasn't like, yeah, it wasn't noise proofed or like really quiet in a way. So that's what technical analysis is. You know, you can discover a lot of information just by looking at these candles, these charts. And then later someone will tell you, hey, you know, 595 is an important level because of such and such a reason. So now we see the result. It being below that rectangle was a big deal. Now you see the volatility. Then you just see it break this level because then in the video I'm going to play, Hans says like, oh, well, you know, did you know that if you went below 5,800, it just gets worse? I didn't know that. All I knew was like this level was important because back in October 17th, 2024, this was the last major high before we pulled back before the election. So this was an important level. And you see, like when we had the results of the election the day after on Wednesday, November 6th, you got to this level. You gapped up, you tested it, and then you bounced up. And then you went back and tested it again. So this level was very significant. And I bet you that's probably where all the options are hanging out, right? There's a whole massive action, like options around these levels, set to these levels. And it exacerbates like people buying and selling. Once we cracked it, right? We cracked it here, but we bounced very quickly. So this is why I bought in January 13th. If you remember my stream that day in the morning, I said Bitcoin, NASDAQ, everything is going back up. And it just went up. Sadly, Bitcoin just lost like halfway through this move, like Bitcoin just went back. But at least the NASDAQ kind of like tried to push up once again around here in February, like first half of February, but after that it just collapsed. It just followed Bitcoin anyway, right? If you believe the fact that like Bitcoin is a meaningful signal of liquidity. So now we have to go lower. Okay, we got lower. We're here. A lot faster than I thought. I thought we could defend this level more. Like this week we would just go and bounce, 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 and then fly up. But well, we got a nice fat red day, which is great because I was all in cash on Friday waiting for something to happen, but nothing happened Friday. Even though you had Jerome Powell talking, you had payrolls, you had the Bitcoin council conference, whatever, at the White House. But overall, it was like, dude, look, all you did was stay inside this rectangle. And then you're going into a weekend. I don't trust weekends. So I'm going to stay out. I'm not going to trust it. I'm going to wait some more. Now we get here today, Monday. Nice red Monday. Perfect place to buy down here when everyone's screaming and yelling, probably panicking, selling down here. Does that mean it's over? Does that mean we're done here? No, we're not done here. This is just the beginning of another big move down. Because once you got this kind of situation, it's too much damage. Like we already had so much damage last week. This bar from last week in the SPY is as large as this green bar, larger than this red bar, larger than these two red bars. Almost, it pretty much covers. Like we actually went down here to this. So even though we ended here, we still had this whole range covered during the election. So this is no good. This is no good. And now you see the 18 is about to roll over. Well, it's already rolled over, looks like. And we're below the dang 40 moving average. The trend doesn't look good because if you go down to that level, you got to bounce quickly. I don't think that's happening here. It's too late. This red candle is too damaging. I have no illusions that this thing would just like break back into 600 and continue on. It ain't happening. Sorry. This is a trading market. Okay, I said this at the beginning of the year, and then Samantha is gonna repeat it again to you when I play her video. Okay, guys, that's it. Okay, let's see. Anything else worth seeing? No, I don't think so. Wheat, corn, soybean. Oh, I'll have to wait on that. Let's see what the oil and gas companies are doing. This one, yeah, it's below a range. Ooh, nasty. Okay, wait. So if you find some oil and gas companies, wait a while. Definitely wait. That's not going to happen. Natural gas itself, yeah, it's doing okay. So boil, like I was talking about earlier, yeah, if you buy the commodity directly, that's fine. But U.S. oil, let's see. Yeah, 65.89 cents a gallon. Okay, let me see the futures price. $65.97. I mean a barrel. My bad, a barrel. Okay. So we're at this level here. All right. Okay. So if it breaks down here, expect a flush. I mean, Trump wants it to go down toward the 50s, huh? Okay, let's watch it. Let's watch what oil does if it breaks down in the coming month. Maybe April. Maybe April will happen. So yeah, I'll watch. Maybe I could buy something real cheap. But otherwise, any other stock is like, nyeh. No. I wouldn't buy for investing purposes right now. It's over. It's over. You see this much damage, it's over. It's done. It's better to come back in September. All right. For May, I think there'll be a bounce in May, but then it's going back down towards September again for some reason, I'm sure. I think probably bonds. That's when the Treasury Department can change all the bond issuance. All right, they'll affect it. Oh yeah, those two other stocks I was talking about, FMCC and FNMA, I was talking about in the weekend. I said, hey, pay attention to this. If Fannie Mae, Freddie Mac keeps pulling back, hey, if I get it $3 or even $2, I'm gonna start buying. Like load up the boat. Load up the boat. Okay. So if you can get a real dirt cheap price, because once they go back to being public, officially public, outside of conservatorship, because right now it's under government conservatorship. Once it finishes that, perfect, good to go. Let's see what else. SMCI, it's still here. So you see this weekly moving average curling back up, the 18. Okay, I'll keep watching this. I think it can hit 60 again. Maybe even this week. All right. I'm not sure, but even MSTR, I'm not sure because Bitcoin looks terrible. So that's why I gave you a whole bunch of tickers to look at. Like even WebL, I might consider. Like I don't know which of these will run back up like violently so well. You know, all of them will run back up, but only a few of them will give you like I want a good return here. Because when you're in a market like this where it's so volatile, it should be easy, very easy to get like dude. Let's say this thing goes back up here. Like let's say 40%. Let's say 40%. Okay, WebL. So let me see. So it tracks FDN. FDN can go up. So that could be 33% at least. 33%. Now, if we get lucky, it gets a little bit higher. Yeah, we could get 40%. Oh man, is it possible? Anything's possible now. Anything's possible with this volatility. So okay, I'll keep monitoring things tomorrow morning and see if I see anything else worthwhile. But just focus on the leverage ETFs because it's just easy to follow the big caps, the large caps. They're the ones that are getting hit right now badly. Small caps already got hit. If you look at IWM, it's dead. Look at this. This is dead. Okay, this is dead. It's over. It's about to be really over. Once it crosses this level here, let's see. What's this level? 196. Like I think it's just gonna die. Yeah, this thing is just gonna die. I think until maybe later this year. So sorry guys, no small cap trades. No more. We can't use them anymore. They're really too risky now. The risk is too high. Yeah, in this environment. Okay. All right, let me go and get the article. Let me see. Okay, let's see. It's not really an article. It's just more like I guess a help. Yeah, you guys can go to it yourself. It's a help. It's a little help guide. Spot Gamma like has a service that shows you all these gamma levels. I think somebody put like some indicators on TradingView too, but I haven't seen if how accurate they are. All right, so a gamma flip. Gamma flip is a term used to mark the stock price at which dealers are estimated to switch from a net positive gamma position to a net negative gamma position or vice versa. So dealers in this case are the market makers. Okay, they're the ones that usually tend to sell you the options. So when you buy options, you're buying from them. Gamma represents the acceleration of directional exposure. If the price falls below the gamma inflection point, then oh man, this must be a mistake. They are modeled to have negative gamma and therefore enabling a wider trading range. This point here with the arrow, where the shaded region flips left to right, is where the gamma flip point is. Okay, so let's look at the advanced understanding here. A trader that is net long options has a positive gamma position and hedges by selling stock as it goes up. and buying stock as it goes down. This can have the effect of dampening the underlying stock's movement and creating a low volatility. So the trader in this case is the market maker. Let's say the market maker, right, has this positions and then they're doing that. Let's say. Conversely, if a trade is net short options, then a trader must hedge by selling the underlying as the stock goes down. Okay. And buying as the stock goes up. This could make the stock more volatile as this trading pressure pushes the stock in its prevailing direction. And knowing how a gamma flip affects positioning in delta hedging needs, as traders, we can understand the effect it has on market maker books, which is what we call market gamma. This casual relationship to gamma positioning and its influence on the market is fundamental to how and why we model market gamma for you each day. Okay, that's just an ad. They want to sell you this information because you got to pay a subscription, right, to get this. So right here, when it says like this could make the stock more volatile. So when we get below this gamma flip area, guess what? So when a stock goes down, they are selling. When the stock goes up, they start buying. When we're above the gamma flip, they do the reverse. They try to make everything less volatile. All right. Oh, manage $500. I don't know, John. I gotta have a system in place. So this was what I was thinking of planning to do last year. I was thinking like if the market was not so crazy like it is now, I would make something where I could make something simple, right? A test portfolio with the ETFs. But because the market is effed up, like since last December, right? Jerome Powell said, no, we're not going to help boost the market. Okay. And then we going into tariff stuff, right? That's it. It's over. No. We are going up and down, up and down, up and down, up and down. So to me, for most people, they would just rather be in cash, like, and just collecting cash, meaning like you are in T-bills, right? Still collecting 4%. That's for most people. But if you're a trader, then you could have some of your money like that, but you can keep some of your money and start goofing off. And because the volatility is so high right now, I can't even swing trade. I gotta day trade mostly. Like you don't trust anything beyond one day now. So that's why it is tough. It is tough. I think if I want to manage people's money, I'd rather do it in a way where it could be done in a very low volatile type market. Not like now. Right now, you're on your own kind of thing. Yeah, that's what we will be. So let me go get back to you like maybe in a couple months by May, okay? Because I think some energy stocks like utilities plus select energy stocks, they can do very well for several months in May, starting May. I'll wait for then. If I see the all clear, good to go. We're good to go. Otherwise, no, not right now. Not these 2 months. Next 2 months. No way. No way. We got to get to May. Survive until May. All right. So yeah, I'll get back to you on that. Let's see what else to talk about. So I think you kind of understand gamma flip, but I talked about gamma in some other streams. I think you can search the title for gamma. I'll probably start like looking and clipping out all the stuff where I went through what it means and how it works in more detail, because this is not a baby definition, let's put it that way. Like what is gamma? Somebody will ask, what is gamma? Oh god, okay, well, what are the Greeks then I have to define you the Greeks again, and like, oh, okay. So but I already did it before, so I can just clip out everything and make a kind of video compilation of all the little stuff I did in multiple streams about gamma. But this is important right now, right? Just like when I talked about the VIX. Like most of you guys don't know what the VIX is, and just like, what's VIX? Why he keeps talking VIX these past several streams? Yeah, most people don't care about the VIX. Okay, yeah. Well, unless you're like King Shenard or something, like he always tells me, like, yeah, always go long the VIX. Yeah. All right. So let's go to the CBOE definition. Okay. Oh God, what is this? Making sense. What is the VIX? How high did the VIX go? Oh, 19%, 27. All right, I'm waiting for the VIX to get to like 30, man. Then I'll be really happy. All right, so what is the VIX? Here, let's see. Let's zoom in this one. The VIX index is a calculation designed to produce a measure of constant 30-day expected volatility of the US stock market derived from real-time mid-quote prices of the S&P 500 index, call and put options. On a global basis, it is one of the most recognized measures of volatility, widely reported by financial media and closely followed by a variety of market participants as a daily market indicator. Oh, well, that's more of a marketing definition, isn't it? But as I would say, I think that's good enough. Good enough for you guys. Let me see if they got the Investopedia. Okay, let's go here. What is CBO VIX? Okay, go away. CBOE Volatility Index, VIX, is a real-time index that represents the market's expectation for the relative strength of near-term price changes of the S&P 500 index. All right. Volatility, or how fast price changes, is often seen as a way to gauge market sentiment, and in particular, the degree of fear among market participants. Okay, let's see. Blah, 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 blah. How does the CBOE Volatility Index works? The VIX attempts to measure the magnitude of price movements of the S&P 500. The more dramatic the price swings are in the index, the higher the level of volatility and vice versa. In addition to being an index to measure volatility, traders can also trade VIX futures, yes, options, yes, and ETFs to hedge or speculate on volatility changes in the index. Yes, options, definitely very important. Very important. You can trade options just based on volatility. You don't even care about the price. In general, volatility can be measured using two different methods. The first method is based on historical volatility using statistical calculations on previous prices over a specific time period. This process involves computing various statistical numbers like mean, average, variance, and finally the standard deviation on the historical price data sets. The second method, which the VIX uses, involved inferring its value as implied by options prices. Options are derivative instruments whose price depends upon the probability of a particular stock's current price moving enough to reach a particular level called the strike price or exercise price. Since the possibility of such price moves happening within the given time frame is represented by the volatility factor, various option pricing methods like Black-Scholes model included volatility as an integral input parameter. Since option prices are available in the open market, they can be used to derive volatility of the underlying security. Such volatility as implied by or inferred from market prices is called forward-looking implied volatility, IV. Okay, that's key. It's implied volatility. That means the VIX is determined by people betting on what they think the volatility will be in the future. Okay. All right. The VIX right now, like the ones you see right now, is just like what's happening currently. Okay. What's happening currently, what they're implied now. But you also can have the VIX in the future, like 9 days, 3 months, 1 month. So you can say, like, oh, well, this is what people think the volatility will be based on what their futures are and all that stuff. So it gets even crazier. So then you have VIX of VIX and all, like, what the hell, the future of the future? Like, I don't even understand any of half of that stuff. Whatever. Okay, that's too much. That's too much for now. You don't need that information. All you gotta know is like VIX is important as a measure of volatility. That's it. Okay. Let's see. Let's play the video. I think I gave you enough knowledge, and we can continue the video that I started playing, I think Friday or was it Thursday? I forgot. I think Thursday. Yeah. So let's continue on.
Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings and welcome to.
So I'm gonna fast forward it a bit. I think I stopped around
long
here.
Call, long 21s. The more you should be selling the heck out of it, right? Oh, expensive options. The problem is.
Yeah. Okay. I was
Day, if
already
you've got some.
Okay. VIX.
The 200 day.
VIX. Okay.
The problem is low vol, low VIX can.
Okay. They're gonna type
selling
here. All right. So somewhere around here, I
a little while. Yes.
Okay, so see, as soon as we get, PE multiples, especially in the Mag 7, since they're such heavily weighted, see NVIDIA, as soon as they start to come down.
Okay, someone asked a question. Okay, do you see the dollar strength? Yes. And it's really tough because like you don't want the dollar too strong, you don't want it too weak, and also it's relative to other currencies. Like right now, the dollar is weakening because the euro is strengthening. And oh my god, yeah, so it's like, yeah, if it was the yen doing more of that, then that would be more of a problem, right? So right now the yen's kind of holding on. If the yen starts getting really strong, oh, all hell will break loose. That's where the yen carry trade will go on. The yield, yeah, so the 10-year yield is also affect. Now when you have a good economy, you're okay with having a low yield, all right, because then you're juicing up the market. Essentially, you're injecting more money into the market from the fact that, like, well, okay, one way is through because margin accounts are cheaper. That's one way, right? But the other reason is because the bonds, right? The bond yields are going down. Then you gotta kind of say, like, well, yeah, that means less financing requirements for small caps, or juicing up the market that way. But we're in the situation the past 2-3 weeks where bond yields have been going down, but the market has been going down too because people are just straight up running away into bonds, and then running away into the euro. And so the foreigners, right, are essentially taking money away because they're saying, whoa, the dollar is going down compared to my euro. Because let's be real, most foreigners investing in the US market who are rich are in Europe, right? For the most part. So when the euro to the dollar right now is changing as it is, the Europeans are going like, wait, hold up. Crap. So not only am I like let's say like 3 weeks ago the market was going sideways. They're thinking like, hey man, come on. Can the S&P 500 get to like break out now over 6,150? If they can't, then they're thinking like, well, okay, I could hold because I'm being patient. But then when they see the euro going up compared to the dollar, they're probably thinking like, what the wait. So even if the S&P 500 stays sideways, I'm still going to lose money because now the dollars that I put into the US stock market are worth less when I cash out, because I got to cash out it back into euros. They're probably thinking like, oh, hell no. So they're probably they're going right back into European market right now. That's why the European stocks this month, February, has been steadily going up and up and up. And then the military stocks in Germany have been skyrocketing last week. Now it's pulling back. All right. So don't chase that. But that's one reason. And then the other reason is that, like, some people think, well, holy crap, if the earnings from Walmart ain't that good, then Nvidia probably doesn't look that good. And then they look back at the whole earnings season. Wait a minute, if growth is slowing down, then why should I buy these overvalued stocks? Because their PE ratios are way too high now, right? They're thinking like, oh, where's the growth? Give me the growth. I'll overpay for something if I think the future is going to go up higher. Like Palantir, right? Palantir is a great example. Palantir is way overpriced, but it still kept going up and up and up and up all the way up until their earnings, and I shot it up into 120. well, now it's like what, back to 80 or something, right back to where it was. So yeah, something like that. You know, we have to worry about this stuff. We have to worry. At this point, though, I think the bond market is gonna chill for a while. We have Powell talking next week. We also have Bank of Japan talking the day before Powell talks on Tuesday next week. So those are going to be big deals. And you know what? I do have an image. I'm going to show you an image, actually. Let me see. So I was doing some intraday cycle analysis here. Now, if you can kind of see, we're at the point where we should be going up. So this was based on Friday's data, not today's data. So this was the last close on Friday for the S&P 500 at 576. If you can zoom in right there. Okay. So if you can see that, you can see it. And yeah, well, you know, we'll see what goes up. We'll see if this week can go up, because what happens is, like, right now, I think we can go up right up until Jerome Powell talks. Right up to then. Let's hope we can go as far as that. I don't even know if the Bank of Japan will kill us. You know, I don't know. But I think we're due for a pump right now. So that's why I've been like saying, hey, buy the stuff, buy the dip.
As soon as we get percent decline in 2025 earnings estimate starts to come down, then you can kind of see this matrix. So, you know, we were talking about already 4,700. That's not a huge level of concern. It'll probably pop up like a daisy. But the point is, then the next one will be lower. And then the low will be lower. And the next high will be lower high. You know what I'm saying? So we're gonna start working down through this matrix.
Right. That's the problem, is that markets are kind of, you know, as we always talk about, perform at the margin. And the problem is the margin is fraying in a very durable way, as you're describing there. We could be looking at the same way we've been sort of propelled higher by sort of incessant record profits and sort of, you know, against all, you know, the sort of rate transmission mechanism, rates rising from almost zero, not really affecting the economy at all because of all this wealth that's been created. We may see an unraveling of that. So that doesn't sort itself out over 2 or 3 weeks or even a month or two. So that's the problem, is that we may have this sort of headline risk. And then, as you're saying, you know, like the analysts are like lemmings, so they're going to start sort of piling on. And that's our problem with this market. So it really is hard to kind of construct a scenario where, unless Trump just pulls completely another 180, it's hard to kind of construct a scenario where the market can overcome what is not just happening now, but the implication that it has in terms of your chart, your graphic you just showed there, over the next little while. It's our new reality is that this picture has very much changed, and that's very worrisome for markets. So we will see volatility probably. I'm sort of looking, I thought, you know, when we rally to the end of the day, I've been looking.
Milligan, it's tough because there's so many threads right now. Everyone has a narrative. The stagflation narrative even is being like talked about like left and right too. Like they're saying like, wait a minute, if service inflation is sticky and we start like seeing too much damage in the manufacturing, then hey, hold on, that'll spill over anyway, and eventually we'll get this crazy stagflation. Oh God, if we get into stagflation, everyone is gonna freak out. But because, like, as you say, like if you look at the bonds, if people really were afraid of stagflation, the bond yields wouldn't be going down. Like hold up, because the Fed's priority is to kill inflation. So if you get in a stagflation event, they'll say, forget the economy. We don't care about it. We'll kill the economy on purpose because we care about killing inflation more. So if that narrative was true, what was going on the past 2 weeks? I'm so confused, right? I think everyone wants to paint a picture of what the market is doing, but let's be real. I think if we just look at the chart and say, hey, your S&P broke below 59.50, and then you went down to 5,800. That's the problem. That's the real problem, because then you just got all these algorithms and market makers just continually pumping volatility into the whole thing. And that's why you're just having like, oh, wait a minute, Trump did this, Trump did that, this guy did this guy did that. It doesn't matter. China's like retaliating. It doesn't matter. It's just because there's so much uncertainty. You can make whatever, and there's so much data conflicting too. Like we had PMIs like last week, ISM PMIs. They all said different stuff. Like there's no clue as what, like Powell's probably confused. And then Powell was like going and talking and saying like, well, economy's fine to me. And then over the weekend, Trump was like, well, yeah, maybe the economy could go into recession. No biggie though. And then his cabinet member had to come out and say like, wait, he didn't really mean it like that. And it's just like, it's like, come on. Hey, you guys just are confusing very sensitive people in the markets right now. All right. It's not helping. It's not helping.
What I did was I was long a number of VIX structures. So the 20-30 call spread in March. March is coming to an end. So
Yes,
so
we have
you
to
kind of
add
have
some
to,
time.
yeah, you kind of have to be looking at April at this point if you want something that's going to give you a little bit of time. So I've had these March structures, which would have done better if this had happened kind of a month ago. Craig is saying, can you show that
I saw
chart
it,
again?
yeah,
And explain
I
the
will.
thought excellent. And then plus I had some short put, long call, long 21s, 22. So what I did was I sold those out when we were around 25.5 on the VIX. That's not necessarily where the futures are. The futures are a little bit lower than that, right? So, but what I did was I rolled into an upside butterfly. So I rolled that. I basically, what that is monetizing some VIX calls that I made money on, and I rolled them into a 25, 35, 45 butterfly. And I think near the end of the day, I think in March, you can get those for about 35 cents. I think those are interesting. If we get a little bit more of a pop on the open tomorrow, if you think that we could get a pop and drop, which has been sort of typical, except for yesterday. Yesterday, the big interesting thing was you mentioned it in your live session in the morning. You said, we're finally getting the drop, and then we got the pop. But we've typically been getting these pops and then drops. So we cannot hold a rally for good reason. And I can show everyone in a moment when we switch over, but there's CTA selling, there's vol target fund selling. They are selling no matter what, just lurking below the surface. So I think you're right to figure that this is, I would be very skeptical of these rallies. And on a pop tomorrow, I'd be looking to maybe pick up even some of those marches for a little bit of a reversal down into the 5,700s or low, down maybe a drop of 75, 80 points. And certainly I would be looking at adding some April at this point to maintain that hedge. VIX in the low 20s, given what's going on, that is not bad. And I've always said to people, I've said, listen, be careful with VIX. Everyone thinks the higher the vol, the more you should be selling the heck out of it, right? Oh, expensive options. The problem is low vol, low VIX can be expensive. A higher vol can be actually cheap, given what's going on. It is a relative product. It is relative to the underlying movement and risk that's going on. So be very careful. Do not think that a 22, 23 is expensive, because I do not think it is right now.
Interesting. Let me just show you a chart of VIX and VVIX, because most people think you cannot, technically analyze volatility. It is a structure, it's a skew, it's a this, it's a that. I technically see patterns, everything, everything. People too, especially people. Anyway, so I just want to show you VIX. Speaking of your cheap, I noticed this morning as well, these August, way out of the money, 42.50, cheap 50 calls with only an 8. It was a little lower earlier. It was like 77 with the IV, few 100,000 contracts. Like they're coming in still, and they're adding time. So they're still planning for a little bit of protection. But the point is, I wanted to say, technically speaking, when this started really in earnest, you could see that Friday, the fateful Friday, the 21st, it was the biggest selling of the year. This actually broke above the 200-day. I'm on a daily. And ever since then, it's really been staying in this nice little structure. Now I have a rule of thumb. It's 1929. Market above is bearish. Market below is bullish. And we're firmly above 1929 in a nutshell. So I also, the other day, for clients said, okay, I don't scalp, but you do. So I'm going to tell you where it's safe to scalp. And this was, we get VIX back inside. This was literally on Tuesday. We get VIX back inside this 2520. You're going to have a nice market bounce. And that was, of course, NASDAQ 100, 200-day. There was some basic.
I remember that.
Yeah.
I remember you saying that. Yeah.
So it's really not rocket science to scalp during the day if you've got some key levels, especially in VIX. But I want to show something, and I've shown this this to clients for a few weeks now, and I don't know if I showed it here in our live session, but I will anyway. If you look over here, I spied early, and you can't tell now, but this is called a bullish engulfing of VVIX on the weekly. And the day before, no, Wednesday the 19th was when I said Q's short underneath 539. And it wasn't rocket science. It was a really, really nice level to short against. I can show that. But the point is, I said below 539. And on Thursday, we had some selling. Volatility started coming up. And I said, this looks like on Friday, right here, you can see this wedge on a daily inside of a wedge on a weekly. So it was basically for that Friday, we're going to go up here and tag that wedge. So it was really easy to say on Friday, that Lotto Friday of the 21st, guess what? We're going to have volatility. It's setting up and it's going to engulf this candle, the prior week's candle. So I'm using candlesticks. I love debating people who say you can't technically analyze a VIX chart. I'm analyzing a volatility of a volatility chart. Anyway, the point is, the chances are, and I said that on the Friday when we had the 21st, I said this is very bearish. It's not bullish. It's very bearish, the market. So we did follow through. And then just recently, we got right up into this kind of 125, poked above and came back in. And it looks like we're done. But that's not how this works. This can go, for the next few weeks before it gets into that wedge and does it again. But big picture, we clearly had a volatility event, but it was not big enough for my choosing. I don't want just 125 for VVIX. I want what we had back in August. Make volatility great again, and then the market is safe to buy. That's what I'm really, and by the way, oscillators are still bullish. That's a stochastic. It's an oscillator for those who don't know. Today, of course, we had on the aggregate, we had, call buying and put selling. That's always going to happen. But at the time that this was happening, we had massive, and we talked about it on that Wednesday, the 19th. We had a lot right back here on that 539, which just so happened to be a quarterly resistance and a prior week and a prior month. And anyway, it was really easy to say, okay, as long as you stay below 539, Qs are headed lower. And it worked. But the point is, they were also coming in and they were going deep in the money, right? The BRKB 500 puts back, out in August, and they were selling calls. So relatively speaking, back then, 2 weeks ago on this Wednesday, they came in and started buying aggressively puts at the money and selling calls above. That helped the whole market structure give sway. And then you add in all the other stuff that I use, which is breadth and net volume, et cetera, et cetera. But we talked about it 2 weeks ago, how they were coming in and they were getting into that place of protecting. We didn't really know why yet. Then volatility started to come up and then it really got busy, but it's petered out. So honestly, we need a macro trigger. I'm always on that. It's not going to be non-farm payrolls this Friday, I don't believe. Jobless claims will continue to trend higher. We have a week of Fed blackout, but Powell speaks on Friday. And then of course, we just have headline risk and tariff terror, whatever Trump is going to next pump on the weekend for crypto. And it's really chaos, right? And the deficit's not under control. And all the bonds are doing are having a pullback at some key resistance levels. But the market right now still isn't safe. I would love to have a volatility surge that we could then buy the market, like with both hands. And then it'll have a reflexive convexity, short covering, whatever, rip to whatever level. We'll figure it out. But we don't have enough volatility for me to get excited about recommending or getting in here and buying the market. That's it in a nutshell. Make volatility great.
Yeah, I agree with you. And I think the VVIX is actually a little bit on the inexpensive side, given where VIX is and what's going on. So I think it could stand to get going. It's actually kind of a curiosity to me. I wouldn't have guessed it to sort of work out this way, because we have been talking about how that upside in VIX, dealers are really, really short that upside, that sort of convexity. And you would have thought, I would have thought that we would have definitely been over 30, given the sell-off that we had, sort of probably, 7% or so from the highs. Insane, but certainly happened relatively quickly, right? The VIX is about speed sometimes, right? If you sort of get,
Find them at LeducTrading.com/Hans.
Very briefly the last couple of days. So that 30-day volatility kind of hangs in there. They're worth what they're worth. The VIX, it needs a little bit more shape.
Sorry about that. Hold on. Pausing this thing. Okay. So Milligan, so when I started, I was just an investor, buy and hold. I got interested in the market from my middle school friend, and he got me into it. So it was back in the old days where, you had to read the Wall Street Journal and get the quotes from there, and then place your orders through phone and stuff. So I didn't have money, right? Come on, we're middle school kids. So in high school, what happened was once I studied more and more about it, I just and this was probably during like the dot-com crash. Yeah, around there, like close to there. So I was looking at it more and more. And then by that time, I was like, hey, I'm looking for dirt cheap stocks, right? And two stocks I picked was Apple and Oracle. And this was right around when Steve Jobs came back on Apple. And so I told my parents, hey, go buy that. And they just bought like maybe $10,000 worth of both Apple and Oracle, right? And Apple was the big winner. I think I buy towards like at 5 years after the fact, they basically paid off most of what my my parents paid for college. So that was paid off because of that. Now, during grad school, I went to grad school. I got salary, okay, because I was a teaching assistant, and also I had a scholarship, so that also paid me to be a research assistant. So I got TA and RA, and I think I was probably the second highest paid a graduate student there. So I didn't have to pay for grad student for master's because that was done by scholarship. And then for PhD, I got paid. So I got paid. So I actually got a salary. I actually have a little 401k way back when, even at that point. And whatever money I got, I started stuffing it into Tesla. So this was when Elon Musk bought. Well, he didn't buy Tesla, right? He just kicked out the old CEO. Like, if you don't remember the history of Tesla, I think, yeah, Tesla was founded and started by some other dude. I don't know his name anymore. Nobody does, probably. If you ask somebody like who founded Tesla, they'll probably think it's Elon at this point, because Elon's been there so long now. And that's when I got it. So at that point, it was like $20. So, and that's before the split. So I think after all the splits, it's probably like as if I bought it at $1 or some crap. But yeah, it was crazy. So you go from $20 to like 200 in like a couple years, maybe even a year. I don't know. And then you ride it again. Like, it goes back down to like whatever. So I started doing that. And then I also bought AMD when Lisa Su came in there. So a lot of my stuff was just long-term investing. Buy, hold, try to find very cheap, underpriced tech stocks that you think has high growth. And there was other stocks like that, like some pharmaceuticals, some internet stocks, maybe Twilio, if you remember that one. There's just some few other ones that I bought cheap and it got up. And so that was my trading style, because I was just an investor. I did long-term stuff. But towards 2018, there was a lot more volatility, right? If you remember 2018, there was a big old correction that went down maybe 15%, 10 to 15, maybe even 20. I don't think it went to 20 though, at the last quarter, right? So I was preparing for that. And then once we got to 2019, it started going crazy. And then, as you know, COVID, it's like even worse, right? So you got more and more volatility. And so from 2018, I was thinking like, you know what? Because the volatility is getting so high, I think I would just be better off learning how to trade. So that's my background. So from then on, I started, but most of my wealth was just because of buy and hold, which is the traditional way. And now we're at the point where we're in 2025, as you can see, this hasn't been a normal market, right? Everything post-COVID, post-2018 even, you could say like, hey, bro, this shit is wild. And I think for younger folks, they should learn some trading, even though I'll still try to advocate for, long-term investing. But for the most part, if you want to beat inflation, because I think inflation is going to be sticky, it's not going to be returning to the way it was, right? We lost globalization. A lot of when I was investing, it was because of globalization, like during Bill Clinton, right? we had Nixon go to China, and then Bill Clinton took it to the next level where we have a lot of free trade in all of North America. So globalization was at full effect. So that allowed you to reap the benefits of corporate America making huge profits. And that's why the stocks could go insane. Like they could be overpriced. Like US markets were just the place to be. So it's just easy to just like, if you could get the right cycles like 2007, 2008, 2000, 2001, if you bought at the right times, you didn't need to, it's no brainer. You didn't need to think about it. But now you see it's like, well, what the heck is going on now? That's the problem. I think you should have knowledge of how to trade. So you should, what I would recommend is this is what I do. Is I trade. So let's say like you could see like the previous videos, you could see what I do. I make like on the day trades, I make like about $1,500 or $2,000, and in a good day, maybe $5,000 a day. And if you do that like every day, every trading day, you have 52 like weeks in a year, 5 trading days, like let's say without holidays, right? Let's say it's 5 trading days. Like you could make like 500K just doing that. Okay, that's just extreme. Like I don't expect people to average out 2K a day trading or whatever. But I would say like it's possible. It's feasible if you know it. And then what you would do is you take that money and then you would so every quarter you would have a goal. You take that money out, and then you would try to invest it long term. So you would have a bank, so like bonds or something safe, right? So trading is just a way to add extra funds, extra capital into your pocket that you can use for your long term trading. That's what I suggest, And depending on the market conditions, I rather do swing trading because day trading is just insane. It's just like a lot of times you just get lucky. I already showed one good luck. Like I bought MSTR like Friday when it hit that bottom range. Like I said, like, well, that's got to be the low. And then because Donald Trump said something on Sunday, it pops on a Monday. Well, that's just luck. But for the most part, I think if you get into the mindset of trading, you could take that mindset and do it with investing too, because everything is with charts. It's possible. You can take it to any level. It's all fractal. Okay. So anyway, so yeah, thanks for the questions. There's always going to be a lot of strange, interesting things that we'll have to discuss as we go on, because I think the market is not going to be easy to figure out starting in 2026. That's when things really get more interesting. So we're just in the prelude stage. Prelude.
Shaky. It needs some shake and bake, as you say. It needs something crazy to be happening. It needs velocity, and that was fairly decent velocity there, fairly good, and particularly given the underlying nature of it, the underlying durability of what was going on. I will say though that in the short term there, we saw the 9-day VIX kind of exploding versus the VIX 30. So I like to and typically I like to see if you guys want to chart that, you can go on stock charts and look at the VXST VIX $ in front of each of those, and you kind of see that it tends to move between 0.75 and 1.2, 1.25. And a few weeks ago I was teaching a class and I said,
and that's an interesting point. So the 9-day VIX versus the 30-day, and he has a ratio where he finds some levels. So that's important too. And we talked about that last stream where we went over the VIX over the 3-month. I think that's what the ratio like Samantha was doing, and there was some levels there, and they went over that. So go back to the last stream and look at that.
And I was showing them this indicator, and I said, listen, that 0.75 is getting a little bit on the calm side. You tend to see that when short-term volatility is so low that 30-day volatility kind of hangs in there. It doesn't want to drop anymore. Almost like realized volatility. When the market gets so quiet, the VIX won't drop from 10 to 9 or from 10 to 6. It will find a floor. And usually that distance between the two is something to be cautionary about. And sure enough, that was pretty close to the bottom. And we got to 120, but just very briefly the last couple of days. So short term, it's kind of needs to unwind. I'd say when that gets closer to 1 again, when that 9-day VIX gets a little bit closer to 1, I think we're going to get another big sell-off. So there's some little tricks you can use in there. That's easy for anybody to follow.
You have a chart of that to show, because I have mine, which I think folks already know is this guy, just for giggles to show. And then you've got,
yeah, sure.
I have basically half a dozen that are right now trying to figure it out. So they don't say safe yet. One of them is this VIX 3-month, VIX ratio, which when it goes down here like it did with August and VIX itself hit 65, huge backwardation and a huge rubber band snap. So they came in and they sold puts aggressively, and we just had whoosh right back up. Now, this happened again recently, and it was a December little swoon there. If you remember, SPX lost 3% that day. So that was the reason for the season in why this particular ratio got right back into the August low. And then, by the way, ricochet rabbit higher and markets got supported. This one's taking a little bit longer. So this one has, by the way, just the other day, it was real time, so we happened to see it. My live trading room moderator and myself, it did come down into 0.9, but it has to stay there. So here's the trick. Yes, it did for a New York minute. And we had a little reflexive bounce. If you remember, we had like a 100-day intraday reversal. It ended up being a doji at the end. We basically had a lot of volatility intraday, a scalper's dream. Anyway, long story short, this is where it needs to come back, visibly come back into this backwardation, and then be a stronger buy. So for right now, we're just kind of playing games with VIX not getting too excited. And that means bears aren't.
So one note to make is, like, this was a presentation on March 5th. All right. So almost a week ago. So yeah.
Pressing, and we're also not getting bulls very excited. I mean, it's okay. Let me just kind of show this.
It's not like the carry trade felt awful, but it was, you could almost think of it as a bit of a localized event. Maybe a furtherance of that, Japan continuing to do it to raise rates would have been an issue, but
and they say they will, by the way. Japan,
they will, right?
They're pissed. Yeah. They're pissed about tariffs. So they said, we're going to raise rates, and that will be very disruptive because of the US-Japan rate spread differential, which was the reason I recommended short. Remember the bank, the bank run in Japan? I forget their name, but the CEO had, he fired, quit, whatever. That was on the 20th, and I said we will get volatility. It will come from abroad in this rate spread differential. It may or may not trigger yen carry trade unwind. That it's too early for that. I said give it about 3 weeks. But in any case, right now we have bounced. I'm just showing you a 2-hour chart of the Qs, and we're trying to stabilize. I see that in my rate differential as well. We've got SPY that we could pull up here into about 592, and I still wouldn't trust it. So it's a scalper's delight. There's no question. And part of the reason, and people don't maybe understand this so well, is that one of the reasons is because yields bounced, and yields right now falling is very recessionary. So oil falling, as I mentioned, this was my trifecta, right?
So yeah, Mulligan. So she goes over it. So actually, Mulligan, you should follow Samantha LeDuc. So let me put the link on there. She's great. Like, I always sing her praises. Like, she's the only one to me, like, that is like very well balanced. Like, she has the macro ideas, she has the technicals, and she has people helping her with like a little bit of the option stuff, with the quant stuff. And I mean, unless if you want to pay money for like the services, like, it is worth it if you're really rich and you need someone to like give you advice on how to manage your money. Yeah, she gives very good advice. Like, out of all the people I've seen, it's just like she's well-rounded, and she has a whole team behind her to fill in like all the gaps of stuff that she doesn't know, right? And that's why I think like, yeah, her team building is excellent, excellent for a small little kind of like quote unquote boutique firm. Like it's basically a boutique firm, right? That's just like, yeah, she's really good. So so somebody would like ask me, hey, I got tons of money, you know, and I need to do something with it. It's like, yeah, okay, go to her. Like the fee she charges you is probably well worth it. And she has her own crypto team and all the other people doing that stuff too, if you're interested in that. So yeah. So I'm always trying to emulate like her viewpoints, you know. And there's a select group of people that I try to capture their ideas. Like Joe Rabel is very good at the technicals. That definitely one person. And then you have the Wyckoff people, very good at the technicals. And then also, oh, what's his favorite? Rick Bensignor. Like he's also very good at technicals. And they all do technicals in slightly different ways. You know, one guy's got the demarcs, one guy's got the other like other stuff, like just looking at bar charts and all that. But Samantha has the macro stuff too, and the options thing. So that's why I'm like, this is the person you should try to be like. And it's gonna be hard though. Not everyone's gonna have spend the time and effort to be this person. But this is where you should be aiming towards. All this little stuff that she presents is like a little nugget. It's just like, oh, I never thought of it that way. Oh, why does the yen have anything to do with like gold prices? Hold up, what? And like, so you know that's where the real information gets out. Yeah, okay. But yeah, I put the link in the chat. That's her YouTube, so you can go there and check out all her YouTube videos. And also like the YouTube videos in the descriptions also have this stuff too. So you should always go look at the descriptions in all my videos. I put in the links for the YouTube. And I'm pretty sure that her website is on there as well. You can like get the QR code like on her presentations. That's it.
That we were going to have yields with oil, with equities dumping. And when they got a bid, this is actually what's helped the market stabilize. So assets are an inflationary thing. And so we need some stabilization in yields. And that's exactly what happened. By the way, all of these are on a 2-hour chart. That's the 10-year. Sorry to confuse. This is SPY. This is the Qs. It is trying to hold. But I have a bigger issue. FOMC is 2 weeks from today. And so far that 3-month, which is, and the 2-year, the closer duration rate structures look very bearish to me. So I'm not excited about the market being so healthy. I actually think that we can have some more volatility through treasury volatility in addition to currency volatility. I'm still on the sidelines until I can get at least some kind of excitement with, because Fed funds that you just mentioned, right? They're pricing in, 76 basis point, whatever. It could rise. So I don't see hiking by the Fed. No, I actually see more of the potential of not emergency rate cuts, but like they did in September, where the yield crash, the 10-year, really fell precipitously into 3.6%. And the next day they came in and they didn't cut 25 basis points as expected. They surprised the market and cut 50 basis points. And that's what helped stabilize the market. Literally, that's what helped a yield spike. So right now we're in a different situation. We actually have a yield steepener. So we're actually starting to move higher in this steepener, which right now it's confusing, but it means that the short end is going to move a lot faster than the longer end. Okay, so what do you got for your volatility and skew and all that good jazz?
Trump and Papa Powell may see eye to eye pretty soon if Powell sort of feels the need. We're going to get rates down, which is what Trump wants. And so, but if you look at this VIX picture here, it's still very, very concerned. You can see the VIX cash, which is the one you see on TV, way above the futures curve, which is just slightly inverted here, but basically flat. So not it isn't super panicky. This isn't an 08 by any stretch of the imagination or anything. A lot of events even milder than that. It is flat and it is very, very worried. So there's no question that we are still pricing in quite a bit of volatility. Does that mean we can't get a 3-day up that makes you feel like everything's okay again? For sure, of course we could get that. We can't underestimate the ability for this market to climb a wall of worry, but a small wall it can jump over. The bigger wall is starting to get pretty high and pretty difficult to scale. And this is a bit of what happened. We talked about this last week, how once we sort of got closer to 5,800, that's when this sort of Vega, short Gamma, short Vega.
Right. Listen carefully, right? So once we hit that 5,800 on S&P 500. Everything started going down really fast, didn't it? This is why.
Situation really started to accelerate things to the downside, which got us almost down to that 200-day moving average. So these are definitely things to keep an eye on. We were in a very healthy, positive embrace of positive gamma up here, as we talked about not that long ago. But it's just been one thing after another. And so interesting, I was looking some of these macro numbers, macro systematic strength, still about 80th percentile long versus the average for the last 5 years. So there is a lot of stock potentially for sale, a lot of people sitting on that sell button. And I think this is part of the reason is that, look, your corporate capital spending, it's funny, we tend to think that, some of the things that take time to kind of unravel. And we're seeing a reaction quite quickly from a few different things. But we saw the Atlanta GDP, which is maybe import-export related to some extent. But look at this.
Partly.
Partly.
Yeah,
But
I was defending it the first time. The first time it dipped negative, I was like, okay, calm down. You're all expecting a big slowdown. It really is exactly imports pulled forward. But then it came out with another negative print. And I'm like, okay, you're on your own. You're right.
Yeah, something's going on, right?
Yeah.
And this is the problem is the wealth effect has really kind of kept this thing going, right? There's no question the lower half has been struggling for a long time, but people planning vacations, look at this falling off a cliff a little bit here. I mean, it was up to recently. I mean, we talked about it last week, 28 days of retail buying. I mean, people have been very, very, very bullish. We saw some parabolas on the optimism for where stocks were going to go. And that's when I pointed out a couple months ago, I said, this is not normal around December before we got that big sell-off. I said, there is some exuberance out there that is a little bit unnatural. That's part of the part of the problem is my 180 theory, that we've come from being so incredibly optimistic to suddenly facing down the train, as you said, kind of the oncoming train. It's not, I like that actually when you said the oncoming train, it's not light at the end of the tunnel. It's a train coming at you, right?
But I have to show you because it is sentiment, right? And we do have buybacks and we still do have the ballast of TGA, which is Treasury General Account. So there is still liquidity in there as it relates to the structure of the market. There are lots of headwinds. We stagflationary ISM today and in services, and ISM manufacturing on Friday was nasty. Contraction, less employment, higher prices. But the point is, this is still the sentiment where we can, and we have in the past, gone hot fire flames because everyone's on one side of the boat too quickly, right? So we then turn around, but I just don't see that right now, technically speaking, or in my intermarket stuff, right? So the yield curve, the rate spread differential, the volatility ratio, the growth value ratio, all that stuff says, I need time. This was too much too soon. We dumped 10% in the NASDAQ in the fastest, by the way, that was really important. The fastest 10% drawdown in the Qs, the top third, all. You saw it in 2008, you saw it in 2000, and then just recently from literally the top three. So I don't mean to have this on. My point is we can get these sentiment shifts that will drive the flow. We know this. And that's how I can honestly tell you I'm much better with timing tops than I am at picking bottoms. I'm telling you, I'm so much better at timing tops. So I look for anything I possibly can. Like today, I could see that they're definitely trying to sell some puts and buy some calls. It's a new structure. I can see that there's stabilization because a lot of my internal warnings that I gave on the 19th, literally, I gave my top 5 and I shared them here. And then we revisited them last Wednesday. I have my new top 5. And the point is they're trying to stabilize. Much happier instead of this choppy little space that we're going to be into the end of the week and next week, potentially into the shutdown. I would much rather just have a solid volatility spike. I'm not going to get what I want potentially, but I'd rather have a volatility spike and then we clear options expiration on March 21st and then we can go in and tiptoe in.
It's possible. I think people are monetizing some hedges, so it's probably replenishing the dealers to some extent. So that's probably a little bit stabilizing as well. So we'll see if that continues. But you can see that vol control. So vol control for everyone is just basically when volatility drops, they start to allocate to markets, to stocks. And then when volatility starts to rise, so basically it's a trigger, it's different for different funds, but if volatility rises, then they have to sell. So this is one of those things that's just kind of sort of self-perpetuating, right? If it's, if volatility is dropping, they buy stocks, and then volatility drops more and they buy more stocks. Well, guess what? This can go the other way as well. So the amazing thing is we're looking at a situation where, I don't know where I have this chart, but it basically shows you that volatility is being sold no matter what. The market goes down, they're selling. The market goes up, they're selling, probably related to your 10% sell-off there very, very quickly. Realized volatility has just simply gotten too high so that, they're basically locked and loaded to sell no matter what the market does. And it's the same for, many CTA strategies. They're just ready to sell. And then on top of that,
Yo, Ava, I don't, I'm not because I think HB is out until next week. Stanley does late night, but he won't have any right wingers on. And man, Portia does have a show, but I don't know if she wants to debate people. She just wants to go over her articles. So I don't think we have anyone for you to debate this week, Ava. I mean, John might if he's available. He's he's in and out though. He doesn't have much. Wait. Why did he wait? So why? all right. Yeah, Portia probably won't, but I don't know. Maybe. Not really even debate, just want a convo. Yeah, I mean, if Portia has one of her shows tonight, go on there and chat. Oh, go on chat and see if you want to have a discussion, Yeah, I mean, that's no big deal if you just want to have conversation, DEI and all that stuff. You know me, I don't like politics. Yeah. But I mean, they already went through a lot of DEI convos and debates several weeks ago. So for the past several weeks, I think. Are you preparing to debate someone, Ava? What's going on here? Oh, Better Faith over here. I guess we're Better Faith. Yeah, it depends on who it is though. John's definitely good faith. Yeah, Portia's good faith. Yeah, they're good faith. But if you talk about other people, yeah, maybe they won't be as good faith. Yeah. Or maybe to them they feel like they're good faith because they kind of just regurgitate a lot of talking points and things. And I just that's why I just don't like these discussions, because then you're just going up against people that have talking points that they already pre-made or they already believe in, and then it's just oh god damn it. Whether it's left or right, that's why it just gets annoying. Then there's just two brick walls yelling at each other and all that stuff. But yeah. All right, Ava.
Which we sometimes talk about, is this massive leveraged ETF AUM, right? So these are the things that happen to be very concentrated in Mag 7, in technology, in semiconductors, right? There are a few other little things in there too, but a lot of it is, when they issue these products, they don't issue it on something boring. They issue it on what's exciting and fun and generally things that are moving around. So the huge part of this AUM is in the things that have been struggling a little bit. And so this AUM has come down a little bit, but the problem with that is you get these rebalancings, right? So on a big down day, you get these products having to sell a whole bunch. And then on an up day, it goes the other way. It's two-sided. You get the upside move being pushed higher. So that exacerbates volatility. And this is our new world, right? As we've talked about many times, this is our new world of short gamma and synthetic gamma like this. And that's our new reality. So we can see that in NVIDIA, for example, I thought this was kind of interesting. We might be setting the table for an actual upside squeeze in NVIDIA. Look, it's just short gamma right across the board there. If we could, for some reason, get going to the upside, it could potentially really go for a run. I'm not saying that's going to happen. I'm not super bullish on it, but gamma is really a reality that we're dealing with these days. And you can monitor something like that on Spot Gamma, or a couple places you can and look at stuff like that. But very, very interesting. But look at this, what a difference from December, 40% no landing, all the way down to basically it's all about growth. It's all about the growth scare. No growth scare, it was all about inflation. Now it's all about growth scare. And I think this is much more impactful, right? Markets can handle inflation to a certain extent, right? Because inflation gets passed on, whatever. It's doable. This is the much more pronounced problem in my view. So this is something that markets are going to have to deal with. So, and then this concentration, right? And I think this week I've been sort of thinking a little bit about this. Also probably speaks to the chart that you love, Samantha, your growth to value. And we can see value starting to push through here. So I'm telling anybody who's willing to listen, expand your horizons. I'm not saying that there isn't a bounce in here somewhere. I mean, some of these mags have really gotten pushed back, and maybe there's some defensive nature to, as we've seen over time, these balance sheet heroes are certainly going to be a place to hide, a place to go because of their quality businesses, the quality of their earnings, et cetera. But at the same time, look around, as long as we're not going into a very severe downturn, look around, there's some interesting places to put money. So I think, if you look at just kind of an index like an SPLV, there's some interesting things that maybe you don't look at too much as some options for safety. I think it still has a reasonable amount of tech in it, and utilities, you got to be careful because of the power gen theme that's kind of embedded in there with the AI. But there's all kinds of interesting stuff in there, healthcare, et cetera, that I think that I'm starting to look at a little bit. So I'm rebalancing a couple of my portfolios. I have a Leaps portfolio that I'm putting together.
So this chart's pretty interesting. So there's a S&P 500 low volatility ETF. Okay. Now there's also like a high beta S&P 500 ETF. So if you can get the ratio of it, you'll see that low volatility is winning compared to high beta. And that means people are running away into stocks that are more stable in this environment. So this has been happening for a while now. And I think now we see what's the result that people were afraid of. We're getting a lot of volatility this past several weeks. And this chart in particular just says like SPLV over the S&P 500 in general. The ratio has been going up. It's breaking out. That's what this chart means.
That I'm going to have some protection on, which is really cool. But it's funny when I start going through things, I'm like, oh, look, Microsoft's cheap. Look, I keep going and I go, okay, Hans, hold on a sec. You can't be all
You're not the only one. Dan Niles, who I respect a great deal, who is a very, very in tune analyst, especially started out in semiconductors. So when he says, I am thinking about getting some of these now, and remember his book is a little bit different than ours, but as it relates to they're on sale. But that doesn't mean they're cheap enough to buy until I feel that they have based and formed some type of, pattern here, macro and intermarket and technical and quant and all that jazz. Like I would love to play, NVIDIA back and forth between this. I'm expecting 106, but right back up to 136 and then right back down and right back up. I mean, this is a channel chopping chase.
It's a trader's market.
Oh my God,
it's a trader's market.
Gorgeous.
Absolutely.
But to invest in this thing, this has gone nowhere. Literally, hold on, since May of 2024. So we're talking about a really long time where NVIDIA has just been hovering around this 116 monthly line, which by the way is a really important line. If we close above, it's bullish. If we close below, it's bearish. Anyway, I think we have about 2 more months before NVIDIA actually disappoints on their next earnings. They already are losing their profit margin. They're already losing their, their golden child status because of China tech coming in and stealing a lot of market share and a lot of their story narrative. But the point is, I don't think they're actually going to disappoint for another probably, until the next earnings. So we can be here sideways. Yes. And anyway, in answer to your question, Someone asked early, I believe you said that SPX is going sideways for 2Q. I did, but I'm bearish in the second half. Do you have a predicted trading range? We're in it. Because I have an SPX target that I still think we're going to hit. 56.70. We haven't hit it yet. I would say we're probably going to hit it by the end of March, and then we'll see what happens. But yes, I think this sideways for right now for Q2 is a safe bet. And then I'm not bullish the end of the year. Okay, so let's see. We hit 6,100 just 2 weeks ago. I mean, that's exactly where we fell on Thursday.
Okay, well, we did hit 5,600 today. So yeah, I think that's my okay, that was my title. So when I set up this stream, it was just before it just started crashing right into 5,600. So yeah, we're well below 5670. Whatever Samantha was thinking end of the month. We hit it. So that's another reason to be like, hey, it's time to go long. Go crazy long. Like dump everything into a long.
The 20th is exactly where we broke, and then we had the swoosh on the 21st. Do we hit it again? I wouldn't be surprised. Honestly, you saw the sentiment tell. We're 60+% are now very, very bearish, and at some point they're going to buy this dip. I just would prefer to have a nice big volatility trigger in order to buy the dip. That's what's bothering me. So and that's what we're talking about. And as far as
feel
silver,
like you've just got to get that flush. You're just waiting for that one final flush that feels like everyone's liquidating, right? Everyone's kind of throwing in the towel. It kind of almost felt a little like that, yesterday, the day before yesterday, kind of felt a little flushy when we almost hit that 200. But I agree. I'm almost wondering if the VIX, if some of the risk gauges are really kind of throwing us that curveball and making us wait for this VIX 35.
We're not done going down. I'm convinced of it. I'm very patient woman. You know this. I'm very patient woman. We're not done going down. We need a VIX flush, period.
I was going to show you this. It'll get bought. I mean, in the back of my mind, I kind of almost wonder if we need to revisit that August 5th low, just because this is going to be, as we've been talking about, just really durable negative headline risk. Analyst lemmings piling on the the opposite side of the mountain as things are going down. They're going to have to cover their asses. So it's going to be just kind of a stream of potentially negative flow. So what you do here is you go VXST to $VIX. And so that's going to give you this, what I've been talking about, sort of looking for that 0.75 as a sign that things are maybe a little bit too calm, to the opposite, which is where we hit today. Okay, we did get a little higher today. So 122, 123, that's a pretty good spot there. So anywhere around 120 is really where maybe we're a little bit extended to the downside, almost like a Bollinger Band in a way, where you're kind of playing the bands a little bit, the extremes that the band is giving you. So that could be something easy that people can kind of keep in their chart list, especially if you're able to kind of keep that in your watch list as a ratio. That's kind of cool too. I'm with you, Samantha. I thank you to some extent. My oil stocks, I thought, you know what, if this is going to be a difficult year, sometimes energy commodities maybe not a bad place to be, but given this sort of growth care stuff and the fact that peace in Russia, potentially more supply, these things aren't looking good. But as good as these companies are in XLE, things just aren't as been for a very long time. It just cannot get going.
Intervention callers. So the problem is that it's not allowed to go, the underlying is not allowed to go too high or too low until Navarro spoke yesterday and said it what they really want to see, which is falling oil will pull down inflation. Expectations will be an economic stimulus of sorts that'll help companies and individuals. That's their baseline bet. But to get there, there's absolutely short-term pain. OPEC's not going to like it, even if they get strong-armed. The U.S. drill, oh my goodness, they're not, that'll set off an oil industry recession. Long story short, they can say all kinds of stuff, but the problem is the timing for an oil short is much harder. Bob, our oil trader, he's very, very consistent in this. He's like, we're in this range, but money managers are not short. They liquidated their longs, but they're not short. There are better things to trade. And he keeps saying this over and over again. And it's a really, really good point. So even when I said, I feel like oil's going to dump, I'm like, it's going to take yields lower and equities lower. And I'm like, I hate having that trader's instinct sometimes because it was at 73. Now it's 65, but I don't have any reason for it, except I just know this is the trifecta. I watch this stuff all the time. Anyway, even though dollar dumped, oil still dumped. So my point is, it's a very, very tight trade. In the same way that we're going to not only get a yen carry trade unwind with an oil breaking that 62. So yen carry trade unwind part 2 is not an issue for me until we can break 62 in crude. So long story short, this is why I would love to have that volatility. But on the other side, I also know what happens when we get volatility. Some things can go break, can really get hit. And right now, the rotation into Europe isn't because of tech. And of course, their defense contractors are getting bid up on sentiment. They don't even have a really large market, but it's because of stimulus. It's because of higher yields. And it's because, they're going to print and somebody said, okay, and America's going to make out because we're going to fund their debt. And I'm like, no, this is not World War II where we take their gold and, we do fine. And no, this is very different. This is not 1939. So I don't get the whole concept, honestly, of this being sustainable in Europe, this particular run higher in Germany, in DAX in particular. I think this will fall on itself. It'll be a kind of a fake breakout, fast failure. Not yet. Again, this is all about timing. And right now we're just kind of letting it play out until we get some more volatility.
Now, in terms of protection, I think, which of course is probably on everyone's mind, what do you do? Well, I kind of like the callers right now because I think you can kind of really pick that overhead area where you're generally okay limiting your upside. And because right now, of course, insurance is very expensive. So, even at the best of times, insurance is expensive in markets. So right now it's extremely expensive. And, the ability to maybe to try to get through, if you think they're going to kind of sort things out a little bit, I mean, I have my doubts. I think there's some durable problems being developed here, but you could look at something like, an Amazon. I mean, I love Amazon. It's a name that I've been buying some longer term options on. In fact, I've been adding, there are some tech names I'm really liking: Amazon, Netflix. I'm trying to think of companies that sort of have these really good moats. We talked a little bit about it last week, but also adding things like, Novo Nordisk and I was looking at IBB as well today because I think that's kind of an interesting place. I don't know. What do you like better, IBB or do you like XLV, Samantha, in terms of kind of the basket of
always
having that healthcare?
100% of the time I'm going to answer XLV. The only time that IBB is going to do really well is one, falling rate environment. And right now we do have that, but for the wrong reasons. For economic slowdown, this is the dangerous part. So always used to be kind of an inverse trade. You go long the biotech because they're so dependent on lower yields and financing and vice versa. But now it's very different. So I have no interest in IBB. XLV has a lot of hardware. IHI is more direct hardware. So medical device plays have been great. We have been very bullish on Gilead, and we're lucky. We've got Dr. Alexander Kenton, who's our resident doctor on our trading desk. So he is all over anything that is biotech. He'll do custom reports like the Tempest, the Pelosi pick, the healthcare proxies, which are not safe, like UNH and such. He's been really, really good about those, getting clients to be out of them, and then focusing on the medical device plays, which have been phenomenal. And there are some that are still trying to get up, but they look much, much better than biotech as an ETF sector. That was a long way of saying XLV over IBB any day.
XLV, yeah. Well, Medtronic, in fact, it's in the SPLV, which is a great company, amazing device maker, incredible balance sheet. So I'm just kind of trying to steer myself towards really, really solid balance sheets that are going to withstand what we're potentially up against over the next year, if it's going to be one of those difficult years. So, just kind of trying to pick and choose here. MSTR, I was trying to bring up my skew chart, but MSTR, I had my little fun skew indicator that
That's
kicked
right.
in
We got a
again.
crypto event tomorrow. Do you have any crypto trades into the Friday White House event? I have.
I do. I picked the wrong horse maybe here because I said I put out my indicator and I said, listen, this is the spot at around 245 on MSTR. It went to 290, back to 235, and now it's at 308. So they're definitely they're favoring. It's more Bitcoin focused, whereas coin is maybe a little bit all over the place. And I think the White House kind of said, well, it's not so much about all these other crap coins and all this stuff. So maybe that's kind of the difference between MSTR and coin. But I put on an upside broken butterfly on coin. I do feel like it can maybe march its way back up there. So I bought some around 215 and I bought some under 200 again. So I've got a really good cost basis on the upside fly. And I think that's a good way to play things right now. If you have a sort of directional view, you can kind of of put on butterflies because it gets very expensive to play things in this high vol environment. And they're also a nice way to limit your risk as well. So when we typically put on our finance plays, you still do have that upside. You've got the high, they're sort of high capital plays, selling an out of the money put. Although you can sell a put vertical, a bull put vertical, which is a way to limit that risk as well. But so long story short, I do have a decent amount of coin into this event, and I've been adding to hood. I'm quite heavily in hood right now. I think that's I like it for so many different reasons. We've talked about it before, so I'm in there. I think it's actually held in there quite well after the initial sort of $15 sell-off after earnings. So I think it's kind of hanging in there. And then I'm looking at things like DPZ. I bought some in the money calls on Domino's, which is of course a Buffett stock. Maybe not Buffett himself, but it's a Berkshire stock. Uber, I will not relent. I'm still good on Uber, and Netflix I mentioned. So just kind of trying to pick away. Reddit, of course. Reddit's really has been a star lately. It came down after earnings, but in the face of all this volatility, it really is kind of hanging in there. So I think that's a story that can still, I think they're doing so well that regardless of where the economy goes, I think they continue to grab market share. So I think everybody just has to sort of really pick their spots, be a little bit careful. Don't keep smacking your head against a wall on something that isn't working, like whatever it is, AMD or whatever,
or
pick
just
your
wait
spots.
until we get a proper flush. I mean, there are people who love this for the scalping and for the high IV, for income generation, what have you. I mean, obviously we're active, but for those who are kind of just looking at, wait a minute, where do I have to rebalance? One of the ways is just to kind of push away from this until we do get some good volatility or a solid breakout higher, like one that breaks out, retests, and keeps going, and we have a good reason for it. Right now, there's a lot of short-term pain in the market as it relates to, of course, tariffs, to be or not to be, and where they were going to be rolled out slowly and then all at once. Retaliation, trade war. China is really angry. Maybe this is going to be leverage and everything's going to be copacetic, but there are ramifications that already are being felt in retaliation by Canada and by China that are not going to be consumer friendly. And companies have to plan accordingly and tighten up and labor shed and all of that. Government firings will continue until morale improves. And basically that means ancillary government contractors and contracts are going bye-bye unless there's, the administration is sued, like in the Supreme Court, and they upheld USAID payments 5-4, then we really, they didn't get very far. But the point is Congress is still pushing through a raised debt ceiling where we're going to be pushing into $4 trillion over the next 10 years. That is very bad for bonds, big picture. It's very bad for our monetary system, big picture. The risks don't go away. The opportunities are if they can get control of this tariff trauma and the tax cuts pushed forward and deficit spending under control and doesn't tickle conflict even more in the EU or God forbid with China. The point is we have this market that is in the stasis of constant worry and constantly trying to figure out what the headlines are going to really mean to market returns. And right now recession risk, as I showed with that one grid, was not being priced in. And it really, really, really should be a little bit more because the fundamentals are starting to change. Nobody really has a model on what's going to happen in the first 180 days of the administration. It seems very much like the market will be gripped in this sideways. That's my baseline bet. I would prefer, before recommending to clients to kind of go in there and buy these things that are discounted, to have a nice proper flush, and then we can go back in. And then we'll be triggered by option flow, will be triggered by buybacks, by sentiment being too one-sided. They all come in and they're all very excited. But I will remind all that retail money that flew into NVIDIA, the strongest impulse of retail money that flew into NVIDIA just 1 month ago is purging, right? So they're underwater. So the point is, this is what the market does. And it was a sold to you market. It will be again. We're in a topping process. Long story short, I think this is going to be very chaotic and I'm here for it. Hans is here for
Yeah.
it. We'll help clients
Yeah.
navigate through it, but it's definitely not going to be an investor's dream. We're not going straight up or straight down. How's that?
It is, exactly. As I like to say, just understand where your torque is. Know what Greek you're dealing with if you're trading options. At times it's going to be theta when you're just watching the paint dry, and at times it's going to be like this. It's going to be delta. It's going to be gamma. It's going to be vega. You're going to sell high vol. You're going to buy it back. It's a market in movement. It's volatility, so you've got to trade the volatility. Even if you're going to be selling out positions, even though something looks fantastic, and you're going to be covering shorts, even though it looks like it's the end of the world. But that's what you do. And the great thing is, it's going to be the world of opportunity in these kinds of environments is great. It's like streetcar. There's going to be another one along any moment. So just grab what you can.
I've got to answer a few questions. First and foremost, this is my particular flavor on a gold silver ratio. It's a little tweet, but just go with me. This is the 2011, high everyone knows about. And then
So this is a good question here with the XLU. I like XLU. I really do. And you got to pick the right ones though, right? The nuclear and natural gas like sensitive utility stocks. Like the ones that like Constellation Energy, right? They bought out some natural gas, so they got the nuclear, then they bought some natural gas one, and so now they got the natural gas plus the nuclear, and then there's also a BKV. It just IPO'd like late last year, like maybe in November even, and I'm looking at that one too. Like it's Texas natural gas. I like anything with nuclear and natural gas, but you got to get in at the right time. Like you see now, like with the whole Nvidia like issue and the DeepSeek, a lot of those nuclear names, anything with nuclear in it, was just following Nvidia up. And then now that Nvidia is like rolling over, they're just going all the way back down. And so you got to get at the right prices. I like it. There's 3 stocks that I looked at last week or over the weekend where I said I re-recommended again, like the California utilities, like PCG, so Pacific Gas and Electric. And then if you're even more of a risk taker, you do Edison International. So they do Southern California where all the wildfires happen. So they got hit. So Edison got hit. And I think PCG probably got hit in sympathy, right? But it's Northern California. There's no Northern California wildfires yet. But maybe they just don't want to have any utility like stocks in California in general. But yeah, if you're a risk taker, go for it. Because it's going to take like about a year before they're going to figure out whether Edison has to do anything about be blamed for any of those wildfires down there. And let's say they do, there's a wildfire fund that already got set up because PG&E had to go bankrupt to get out of getting lawsuit to death. So California is going to protect a lot of those monopolies, I think. And, Gavin Newsom, he's basically in bed with those utility companies. So he talks a good game, but yeah, those utility companies are in his pocket. So that's it. That's basically it. And there's also Hawaiian Electric. I love Hawaiian Electric. You just buy it $8, $9. It's at like 11. It got pumped like on Friday with some re-ratings. So these are 3 stocks, yeah. Right here. PCG, EIX, and HE. So Edison International, Pacific Gas and Electric, Hawaiian Electric. Those 3. So those are like the most bargain basement, like undervalued ones. Now, as I said, like so BKV, CEGs, Constellation, and BKV is I forgot what the heck the name is. What's its real name? Oh, it's just called BKV. I have no idea what the initials stand for then. So it's just BKV. And there might be another one. I haven't looked at this one too much. TLS? Let me see. I think it was TLS. Or something like that. Oh man, I can't even find that one then. So what is that? Competitor. TLN, maybe. Okay, TLN was it. Okay. So yeah, look at this one. Okay, TLN. All right. Talon. All right. Okay. TLN. Okay, and look at these ones for the nuclear, natural gas type energy stocks. Yeah. So BKV, CEG, TLN. So yes, I do like XLU, but I gotta wait and see. Yeah, I gotta wait and see if this is gonna like go through, because like if it's too tied into how well the AI story, because a lot of these utility companies they got tied into the EV story, right? The AI story, and if the economy is gonna slow down, maybe the multiples don't justify the price they're at now. But that's why I said, like, if you want something bargain basement, PCG, EIX, HE, because they're still way cheaper than they should be. Right? The other three, well, maybe they're overpriced right now, because if they got to get re-rated at a lower price multiple, yeah, you don't want to buy them even at the current levels, because even they pulled back a lot, but it's probably not worth it, maybe. So we'll see.
This was the most bullish chart for anyone who follows me on Twitter. I put this out because I really expected this to be a beautiful breakout, kind of like we happened to break out very, very aggressively in March of last year, if you recall, this big stick figure right here. And this is basically silver, then followed a month later. It had Jeffrey was all over this, our economics advisor. He really trades precious metals and bonds and foreign markets better than anybody I know. Anyway, this is something that exploded higher. We had a little pullback to support. Now we're extended. So in answer to your question, you got a whole bunch of them in here, but basically, is this the year for silver miners? Finally, they're in like second or third inning, and it's a longer period of time that this takes. So I don't know what your investment horizon is, but this particular gold silver ratio is on a monthly. So like, I'm not looking at this as a day trade. I'm not looking at this as a multi-week trade. I'm looking at this as a multi-month, multi-year trade. Gold and silver are in trend. If you're looking at a shorter time frame, you kind of got to let me know. Wheaton, for example, long since last precious metals. I mean, look at this thing. It's stunningly gorgeous, and it still continues. So it depends on your miner. They're not all created equal. This AGI is also gorgeous, was also one of the ones recommended. But the point is, I like miners, but they're also going to have some indigestion. And right now, silver is a little bit tricky, not just today. It went hot fire flames. And by the way, I am wrong-sided on this. I thought we were going to have follow-through. When we had selling in gold and silver last week, I thought we were going to follow through down here. We did not. So right now, my short duration timing on this gold and silver trade is not so hot. My trend trade is very hot. So to answer your question, it's fine. And the more depreciate the dollar, devalue the dollar, then obviously gold is fine. Right now, if they were to, and I should show you continuous contract, if they were to actually pull out of these conflicts abroad, I'm trying to show you gold continuous contract, then gold would fall. Precious metals would actually fall. Here it is. Okay. But guess what happened? Just as war is peace and we were having gold pull back, boom, Europe is going to do stimulus and support the conflict, et cetera, et cetera. So hopefully that helps you. I already said, yes, I saw SPX going sideways the beginning of the year and then rolling over towards the second half, and recession risk gets pulled forward. So far, nothing has changed. As it relates to SPX and NDX outlook, that's it. Capital flows right now are leaving because they're chasing yields elsewhere. Some of it's also going into China, and basically we'll have to see how far that goes. But this is capital flows that you can see. This is the dollar on a weekly. This is the dollar on a daily, 1, 2, 3. It'll have a ricochet. It'll have a little bounce here back up into 105. This is money flow right there. As it relates to sectors, I'm not fond of biotech. I'm sector rotation. So I go when growth is in vogue, I will absolutely position clients long for growth. If value is in vogue, then we position for value. Right now, value has been leading growth by a nautical mile. When neither growth nor value leads, we get volatility. I'm waiting for volatility volatility before growth is another solid buy. And when it comes to Europe, what are the most attractive markets? Poland, actually Italy. She said she's not going to send any troops or money for Ukraine. She's probably going to fare better, honestly. And I did answer everything except, do I see NVIDIA under 60 this year? Do I see NVIDIA under 60 this year? I definitely see 90. So here's NVIDIA, bigger picture, 90. I definitely see 90. We talked about that. I'm going to wait on that one because I think this is going to take another 2 months before we actually get disappointment from NVIDIA and we head back down to that 90. If we break 90, then sure, we're going to head back actually lower. It's too early right now. Positioning for 90 is basically positioning for an economic crash, and I'm not there yet. I hope that answers all your questions, and it's way late. Hans, thank you so much. We'll do this again next week, and then we'll have FOMC, and we'll recap on the 19th, right before options expiration, month end, which is a big quarterly one. You'll get to tell us all about that next Wednesday so folks can prepare for options X.
All right. Good. So it's 2 hours now. I think we covered a lot of stuff. Let me see. How long is this other video? I had another video I might play. Let's see. How long is this one? 14 minutes. All right. Okay, 15 more minutes. I'll play this one. From the double line guys, who's run by the Bond King, Jeffrey Gunlock.
Hi, and welcome back to Channel 11. Today is Tuesday, March 4th. Some volatility in the markets. Big sell-off the last couple days in the equity markets. CNBC is freaking out, and bonds are rallying. So let's take a look at what's going on. Land of Gains is giving back much of its gains. The rocket ship is a sad face. It's been going down. We broke through the 200-day moving average at one point intraday today. We bounced off that. Looked like it was going to be a rally into the close, and we sold off into the close after that brief rally in equity markets. So what's been going on out there? Well, there's been a massive change in sentiment around growth. There was all these high expectations of growth, excitement about a rebound and reacceleration of the economy with the new administration and policies they would put into place. But the data, which is obviously backwards looking and has nothing really to do with near-term policy, has been coming in weaker than expected. So here's a city surprise index. We haven't looked at this in a couple months, but we can see that that hasn't been surprising to the upside. In fact, we've been getting some downside surprises, and with that, rates have been coming down. We just got some updated data coming into Atlanta GDP Now forecast, coming in now at negative 2.8% for Q1. A caveat here is that a lot of this has to do with how this forecast is calculated, and there's a lot of front loading of imports coming in with businesses worried about tariffs. They're purchasing goods they need for their businesses, and that front loading is taking that GDP Now down in negative territory. This I
think that's pretty interesting. Yeah, I mean, yeah, the Atlanta GDP Now metric is now negative, so we're already in a recession. Just because the way they calculate it, it's like, oh, because everyone's pre-ordering everything they need, because they want to buy everything before tariffs get into effect, then the whole GDP is negative right now. All right, hey, all-seeing guy. Yeah, they are very thorough. They know what they're talking about. And a lot of that stuff probably goes over everyone's heads most of the time, but you'll need it for this kind of market. When the market's trending, you don't need that much detail. But when the market goes sideways, now you need to know what's gamma, what's VIX, what's this, what's that. Yeah, because I think for most people, they're just better off just getting T-bills or a CD and just wait until late 2025. Buy again, and then we'll have one more bump up in 2026. But then be ready to pull out real quick if you see trouble in 2026, because that's when I expect some bad thing to happen. Something nasty will happen. Yeah.
I think as more data comes in, could smooth out. And so I wouldn't read too much into this, but this, again, one of the reasons that rates have been coming down and risk markets have been selling off. Another way to look at that big spike in imports is the trade balance. You can see this big collapse down here in the trade balance has to do with that front loading of imports. Big rotation out of Mag 7. You can see Mag 7's been suffering here. We're going to see this more in detail as we go look at the different subsectors of the market. And that theme that we've been talking about, liking here a double line equal weight more so than the market value weight. You can see market value weight really underperforming equal weight. So that with those high flyers coming down, that equal weight has been doing better. Also, we've been watching the speculation out there, the speculative fervor collapsing. We looked at this last couple months, and it kind of continues. Bitcoin, I guess, on this short time frame doesn't look that bad, but things like Dogecoin, ARK, Tesla, all having some big reversals off their exponential charts that we saw over the last couple months. AI, looking at semiconductors, are we past the peak AI frenzy? Again, this continues to weaken, so we'll keep an eye on this as well. Trump trade reversals, another theme that we've been talking about. It was off to the races for small caps, for financials with deregulation. They were going to push inflation higher, so rates went higher to start the year. And the dollar was getting stronger with rates higher. With a 10-year reversal in yields falling, that's brought the dollar down with it. Financials have really the only one kind of hanging in there. Small caps have gotten hit, and now financials finally, can't keep away from the beta of the market with the sell-off in broad equities. Financials starting to get hit a little bit, but obviously, as you can see by the chart in the bottom left, still doing better than these other sectors. Equity performance, this is now looking across both developed markets, Europe on the left, one of the best places to be. And then on the right-hand side, you can see small caps, tech, the laggards, EM kind of flat on the year. So I guess not the worst place to be, but it's really been all about Europe and that Make Europe Great Again or mega trade that's been coming into fruition. Here's another look at the different international equities and local currency. And it's really the European stocks that have been on fire. UK in the top right, Euro Stock 60 in the bottom right, EM kind of going sideways as we just saw, and Japan kind of struggling here with inflation picking up and rates kind of staying high, and perhaps they have to hike rates there. And so that's been one of the issues over there in Japan. But I do think valuations still look interesting in Japan, and I think in the longer run, it could be a good place to find some opportunities. The Make European.
Hey, all seeing guy. So if you're using a UVXY, you can also use UVIX. Okay, UVIX is performs a bit better than UVXY. UVX is like 2x VIX or something, or that's what they claim. I don't know what the heck they're 2xing, but it's up like UVIX is up 22% today.
Make Europe Great Again, another way to look at it. This is the S&P versus the MSCI Europe Index. You can see that massive outperformance started in 2023, went through all of 2024 into the beginning of 2025, and this is a huge reversal as U.S. equities come down and European equities do well. We're off very high levels on the S&P, so I'm not really surprised here. But there's been a lot of times when we've thought that Europe's been the place to be, and it kept reversing, and the U.S. kept catching up. So is this time different? We'll have to wait and see. One of the things with the European indices is they just don't have as much tech as we do.
Yeah, that's a good point about this one. Like you heard Samantha talk like previously. She was like, well, Europe always tends to do this. They do a fast pump and then they just do a dump later, like really quickly. So I don't know how sustainable it is. I think China has a better chance, and we'll see. Mexico, I think the ETFs are coming back down. So I'll see if I have to do the Mexico again. We'll see if I do.
So it's much more industrial focused over there than it is in the US. This is just an amazing chart. This shows you the euro after the first Trump election, how it sold off into the election and then started rallying again. It almost looks identical. So keep an eye on this, because with weakened foreign currencies like the euro, if it could be a tailwind for your returns, with the equity indices posting positive price return, and then also making some money on the local currency appreciation relative to the dollar as well. Looking at the yen, it's off its cheaps, got all the way back up to that 155 area. Now we're sitting about 148. And with Japan on hold on cutting because of inflation, and perhaps rates coming down in the US, you might see a continued rally in the yen. Commodities off their local highs, along with the growth scare that's coming with that's bringing the equity market down. I think that's also pressuring commodities. So everything's kind of flat to sideways, except natural gas, of course. Probably has to do with seasonality there with cold weather. But gold, look at gold. Precious metals up 9+%. Performing assets out there this year is gold, which is amazing after the run last year. And I think it has to do with with so much uncertainty and fears of tariffs and global uncertainty. It's just a new place to go that you don't have to deal with all the currency volatility that's out there. Interest rates, it's been a wild ride, but if you go back about 2.5 years to the summer of 2023, it's like nothing happened. The 5 and 10 year are almost the same. The 2 years down. The long bond's up a little bit, but it's just been a wild ride. Kind of that call it 470, 480 level on the 10 year recently, got up all the way to 5 in 2023, and it's had trouble breaking that 380 level. Here we sit today in the low fours, and I think the market's maybe a little bit overbought on the bond side. We got the 2 year at one point down to, I think, a 380 handle today, and I think that stocks are probably going to bounce off the 200-day moving average. We've got extreme negative sentiment. If you look at the AII investor survey, usually.
Well, we went lower today on Monday, about like several trading days after this presentation. So yeah, who knows? Who knows where the real bottom is? So I just put my bet today. Let's see what happens. All right, guys. Actually, a couple days ago, Millennium, some hedge fund called Millennium Management, lost $900 million. So great. This is not looking good for some people here.
When sentiment is so bearish on stocks, stocks are down 10+%, 10-20%. I know we're only down 5, but the sentiment is so bearish. I almost feel like it's time for a little bit of a bounce here. And if equities bounce, I think rates bounce with it too. It's just been an amazing whipsaw of higher for longer. No, the Fed's going to cut higher for longer. No, the Fed's going to cut higher for longer. No, the Fed's going to cut over the last couple of years. So, if that jobs report this weekend on Friday comes in pretty good, that could be something that would reverses fixed income and maybe gives some tailwinds to equities again. So let's see what happened in Feb. Good month for bonds. It was a challenging couple of years for high quality fixed income. It's credit, deep credit has been the place to be. The risks have done really well. But as we finally get a bond rally here, you're seeing, at least in February, the far left of this chart, these are high quality parts of the fixed income market: treasuries, agency mortgages. In the middle, in the beige, investment grade corporate bonds up 2%. The aggregate index up 2.2%, bringing year-to-date returns. Agency mortgages finally, after years and years of underperforming treasuries and corporate bonds during this sell-off of the last couple of years, they're from the cheap valuations that we've noted here on Channel 11, agency mortgages being cheap. And now it's time for them to shine. So agency MBS, top performer in the high-quality fixed income category, up 3.1%. Versus corporate bonds up 2.6, treasuries up 2.7. So make mortgages great again is something we joke about here as well. The curve, we've had a steepener on in many of our strategies that continues to work in the long run. It's obviously a volatile ride with the markets, but even today, the front of the curve was down, the long bond was down about a point. What a dramatic change from the beginning of the year in Fed funds. We went from December 31st of last year, I think the market was pricing in around 1.75 cut through the end of the year. At one point, that got down to almost just one cut through the end of the year, this year, 2025. And now, at one point today, in the height of the bond rally, the market was pricing in 3 cuts. So a big change in sentiment around growth, worries about tariffs. You had the last services, ISM services come in weaker than expected, although still above 50. You had retail sales in January come in weaker than expected. Part of that could be due to LA wildfires. Part of that could be due to cold weather around this time of the year. But we've got some new ISM services data coming out later this week. We've got some more retail sales in the following weeks, and that should get us insight into the spending on the consumer side. And then the jobs reports are going to really give us an idea of what the labor market's doing. So I think these job reports are going to be really important in the coming weeks and months. Inflation expectations, they spiked higher because of all the tariff talk. And so you can see the 2-year break-evens pushing higher. But with rates coming down and growth fears, you're going to start seeing some of these break-evens turn over, I think. But with the rally in bonds, real yields not looking as good as they did. We got all the way
Oh, sorry about that. I think this thing just got froze. Oh my god. All right. Hold up. Man, we're almost done. Come on.
versus corporate bonds up. What a big change in sentiment around growth, worries about tariffs. You had the last services, ISM services come in weaker than expected, although still above 50. You had retail sales in January come in weaker than expected. Part of that could be due to LA wildfires. Part of that could be due to cold weather around this time of the year. But we've got some new ISM services data coming out later this week. We've got some more retail sales in the following weeks, and that should get us insight into the spending on the consumer side. And then the jobs reports are going to really give us an idea of what the labor market's doing. So I think these job reports are going to be really important in the coming weeks and months. Inflation expectations, they spiked higher because of all the tariff talk. And so you can see the 2-year break-evens pushing higher. But with rates coming down and growth fears, you're going to start seeing some of these break-evens turn over, I think. But with the rally in bonds, real yields not looking as good as they did. We got all the way up to north of 2%, real yield for the long end of the curve. On the front end, the real yield based on short-term inflation expectations is basically 0. So not looking as good as it used to on that front end of the curve. Spreads are a mixed bag. With equity volatility, we've seen spreads start to widen. Part of this has to do with the rate move has been so violent and quick that there's a lot of buyers that are yield buyers that, they're insurance companies. They said, okay, if I can buy a single A bond at a, 5.5% yield, that's pretty good. And but when rates fall, 30, 40 basis points, all of a sudden that 5.5 yield becomes a low 5 yield, or that 5 yield becomes a 4.5 yield. And they start boycotting and saying, I think this rate move could reverse. So why don't I widen the spread that I want to buy this asset at? And I want to buy yesterday's yield. So yields are kind of unchanged, all-in yields, but with the base rates lower, credit spreads have definitely widened on that front. You can see that they're almost wider in every sector except agency MBS, make MBS great again, and CMBS BBB minus, but we don't see too many of that trade. So I would take that spread tightening with a grain of salt. We definitely see high quality fixed income about 5 to 10 basis points as you go down the capital structure. Here you can see IG it got sub 80, now it's about 88, so a little bit of spread widening there. High yield, I think at one point got to around 250 spread, and we got about 30-ish plus basis points of spread tightening on high yield. And now my favorite chart, the what looks cheap report. The dots are moving up. It's not as bad as it was a week ago when you had investment grade corporate bonds at first percentile, high yield at first percentile. Still not looking screaming cheap, but at least we're getting a little bit of softness in the credit markets. Top left, you can see all sorts of mortgages looking cheaper. We added legacy RMBS, which are those bonds made before the global financial crisis. There's still some out there, and that's also one of the cheaper parts of the market. We wanted to add that in there because there's been some questions about it. So good luck out there. It's been a volatile couple days, but stay calm, stay patient, and keep some dry powder for opportunity.
Yes, yes, yes. Keep the dry powder going. So I'm going to end this with 2 charts. Let's do this. I think there's a Starlink satellite as a new fixture in the night sky nearby. I can't figure out what else it could be. Do you have a telescope? Now, sadly, a lot of telescope companies have sent their manufacturing to China, and the Chinese have basically ended a lot of like those product lines. There seems to be a lawsuit for a lot of those popular brands like Orion, Celestra, I think it was. I have an Orion telescope. I'm not sure if I'm part of the lawsuit though. Celestion, whatever. There's some people on YouTube complaining about it. Oh man, telescopes. Yeah, I used to be some kind of an Celestron. Yeah, Celestron. Yeah, they're gone now. So I don't know where you can buy like good telescopes, because for cheap amateur telescopes, they were pretty good at entry level ones, for the amateurs. Yeah, I got into it when they had what that comet was crashing into Jupiter during the 90s. It was something Levy. It was like Levy, Comet, let's see, Jupiter, a Shoemaker Levy. Yeah, Shoemaker Levy. That was a good times. Good times. So yeah, you could get some powerful binoculars too, all-seeing guy. Get some really good binoculars. Hell, if you got a rifle scope, maybe you could just use that to point at the sky. You could probably see something. Yeah, good quality rifle scopes probably have enough power to see some of that stuff. All right. No telescope here. Yeah. Get a binocular or rifle scope. One of those should work. Anyway, let's see. Okay, hold up. All right. So this is the yield curve. I used the 2-year, 3-month. Okay. Jerome Powell likes to use the 2-year and 3-month 18-month futures or something like that. Hell do I know. But I'm using whatever I can on TradingView. So I'm using this one. And we almost got an inversion here, so we didn't make it through. So I'm using a moving average to smooth it out too. Ready for a recession, all right? We haven't gotten there yet. Actually, an interesting thing to note is that we did cross over just before COVID-19. Interesting, isn't it? And of course, the last time we did this was during the Great Financial Crisis. We went under, we went over. What it is, we went under. Now we got to get back over. Once we get back over, then yeah, maybe this is a signal of recession, but we haven't gotten there yet. So my target is maybe sometime around August. We'll reinvert. Maybe that's also where the Treasury will redo their bond issuance schedule and all that, and maybe that'll shake up the bond market and that'll push it up. But who knows? Who knows? Now we use also crude oil follows gold, shifted by 19.8 months. So this black line here is just crude oil prices right now on the futures market. Now I use this one, this green reddish thing here as the gold price, and I shifted it up 19.8 months. And it predicts it quite well. I don't know how it predicted the whole Russia-Ukraine thing, but that was a nice peak right here. Yeah, pretty much right here. So now we're going to move down. Now you can see it's not perfect, right? This was saying like gold was going to move up between August 2024 into January, but we just went sideways. So not always a good one. And this one, it said it was going to go down between November and July of 2024, November 2023. we also just went sideways. So sometimes, what can you do? It's not going to be perfect. But for the most part, I think the most important thing is like you had a big move up, right? So this thing predicted that it was going to move up between 2020 and 2022. That was correct. And gold now predicts we're going to have a big move between June of 2025 into October of 2026. So this is where I'm very interested in oil and also natural gas. All right, guys. Very good. Where you see the no, you couldn't see it was too far away, but you could see the impact. So if you had a pretty good telescope, you could see the comet like go hit Jupiter. Like you could see the face of Jupiter getting scarred up by the impact. So that was like pretty sick, Yeah, that was a good time. That was a good time. I mean, that was probably the last big event that you could use like low power telescopes, astronomy level, and you could see some really cool stuff, because most of the cool stuff you can see with basic ass telescopes require long exposure. So you would have to have a telescope sitting outside, and it would have to rotate with a motor. So then you would have a camera like with its lens open, and the whole motor has to track the rotation of the sky, right? Because the Earth is rotating. So then you would have to like wait how many hours, and then you have to get the results at the end, and then you could see something good. If you told people, hey, I just go look in the eyepiece and see something cool, no, I'm sorry, it doesn't look like those photographs they give you right in the books. Yeah, because that requires you to wait a while to get the exposure from the camera. So that sucks. That's why astrophotography is a whole nother game too. If people are really into that hobby, that's a crazy hobby too. I don't know. Boomers love that stuff. So I used to go out there, and there were all these boomers. They had these fancy setups with all the motors. They actually hand built them, back in the day, because they couldn't afford like the real stuff. So they had to like build them themselves, but they liked it, right? They liked it. Crazy times. But the same people that made high quality telescopes, they also made high quality rifle scopes. So if you had a good rifle scope, you probably could see some pretty good stuff. You won't be in greater detail, but at least you can scan the night sky with your rifle scope, and then you could see like if there's some kind of like shooting star or something that looks like a star that's moving fast across the sky. So a Starlink satellite you could see probably like that. Yeah, but you won't see the detail of the damn Starlink. Yeah, you won't actually see the dang. It'll just look like a point in light that's just moving kind of weird across the sky. It'll be like, oh, is that UFO? Is that Starlink satellite? Yeah. But yeah, you can check that out. Anyway, guys, good. We're gonna have a tough several weeks, I think, going to April, and then I think the real bottom will probably be May. If we're not, if Jerome Powell like says some really nasty stuff next week, yeah, see you in May. Forget April. See you in May. Yeah, tax day is coming up. Everyone's gonna have to cash out to pay taxes, don't they? All right. So yeah, if anything interesting happens, I'll come in the morning. But if nothing, I'll just come in the afternoon. I don't know. It kind of sucks. Like, this morning it goes down and then it tries to get back up, but then you could tell within 1 hour after the opening, it's like, it's just, it's tilting back. It's going back. Oh man, because the volatility is so high. If you don't have a good start, a running start, bye-bye. Just wait till the end of day and you can buy something. Yeah, if you're looking to buy. Otherwise, you got short, right? But I'm not really interested in shorting right here at the bottom, near the bottom right now. I'm just waiting for like the big squeeze up. And once we get the big squeeze up, then you can short. Okay. So I'll see you. Yeah, 2 hours, 30 minutes. Perfect. Oh yeah. Yeah, I got to do my little shilling here. Let me see. Let's see. All right. I think we got 1.29K subs, almost at 1.3 subs. Please like and subscribe. Yeah, thanks for showing up, Milligan. Yeah, I mean, oh man, I wish I had like a whole set schedule of things to talk about, and I wanted to get like a dang blog going on Substack too, so I can just keep track of everything now, because I got enough records to keep track. But it's a tough market, definitely way too tough, way too tough. You gotta be at advanced level, I think, just to deal with this crap. But yeah, please give a like and subscribe. That's right. And you can give a Cash App to Portia J. All right, $PORSHAJAYE, or PayPal at PORSHA@jghb.info to support the channel upkeep. She does all the administrative work and keeps everything flowing here on this channel. It takes a lot of effort to deal with all this stuff in the back. And otherwise, you can email me at GetCrack, all right? CRACK@jghb.info. All righty. I'll see ya tomorrow.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should. Go.